Nothing can be certain except death and taxes. Good morning all. I, Advocate Siddhi Palukar, welcome you all for today's seminar on the Tax and Securities Law, organized by the Goa High Court Bar Association in collaboration with Goa branch of Institute of Chartered Accountants of India. It is an honor to have esteemed guest speakers with us today to grace this occasion. I am sure that their insights and experiences will enrich us on this topic. I now request Advocate Datta Prasad Lavangal, Vice President of the Goa High Court Bar Association, to formally welcome the gathering.
Good morning, all. Honorable Justice Mahesh Sundar, Justice Jiten Jain, Honorable Shri Justice Securites Laws, Honorable Justice M.S. Keja, Senior Advocate Mr. Koyero Pereira, President Goa High Court Bar Association, Mr. Milind Shirodkar, President of Goa Wing, Institute of Chartered Accountants India, Advocate Shivan Desai, Secretary Goa High Court Bar Association, Senior Advocates, my colleagues, distinguished CAs who are present here. Goa High Court Bar Association, in collaboration with Goa branch of Institute of Chartered Accountants of India, welcomes all of you present here today for this workshop on tax and securities law. We all know tax and securities laws plays an important role in ensuring financial transparency, stability, and fairness in economy. Whether you are an accountant, an advocate, or a business professional, understanding these laws is crucial to navigate the complex financial sector effectively. As far as the taxation is concerned, there is always a tendency on the part of the assessee not to pay any tax or to pay minimum tax, whereas there is always a tendency on part of the revenue to collect maximum tax. And I believe the core of the litigation starts from here, that is to pay minimum tax or to pay the maximum, to recover the maximum tax. That is the core of whole litigation. The workshop will deal with different aspects like how income tax matters are handled, focusing on appellate process and writ jurisdictions, practical approaches to managing income tax issues from compliance suit strategies for handling audits, dispute effectively, the regulatory framework governing the market behavior, address concerning around financial markets, abuse, and highlight key practices to ensure compliance with financial regulations. It is truly an honor to stand before you today and extend a warm and heartfelt welcome to this gathering. We are privileged to be in the presence of some of the most distinguished and finest legal minds who have dedicated their lives to justice and strengthening the foundation of legal system. First, I extend my deepest respect to Justice M.S. Sanklecha, retired, who has a profound knowledge of law, and his landmark judgments have left us enduring legacy. Even after retirement, his dedication to legal field continues to his work as an arbitrator, guiding the next generation and his wisdom. Welcome, sir. We are equally privileged to have Honorable Justice Jiten Jain with us. His exemplary work in indirect taxation and RTI matters has made a significant difference, particularly ensuring greater transparency, accountability within governance. His dedication to law serves as an inspiration to all of us. Welcome, sir. We a very warm welcome to our Honorable Justice Securites Laws, whose seamless transition from advocate to judge has nothing short of an inspiring journey. His deep understanding of security laws, corporate governance, and insolvency matters is invaluable, and we are fortunate to have him among here. Welcome, sir. And of course, we welcome Justice M.S. Sona, our own judge from Goa, and his remarkable journey from Goa to Bombay. The High Court reflects his dedication to upholding the law. His contributions, especially in constitutional law, have been a guiding force for us all throughout, and we have always given wholehearted support for organizing such events. Thank you so much, sir, and welcome. And with this, I also welcome all my fellow colleagues who are present here, senior advocates who are present here, the members of the Goa High Court Bar Association, and office bearers of the Goa wing of Institute of Chartered Accountants. Welcome, and may you have a wonderful session today which should be learning and enduring for all of us. Thank you.
Thank you, sir. We would now like to present a welcome token to our esteemed guests as our deepest appreciation for their presence for today's seminar. We would like to present them a state fruit of Goa, which is a Goan kaju, which derives from Portuguese word kazu, which literally means nut that produces itself. I now request Advocate Maria Simon Korea to present a token to Honorable Sri Justice Mahesh Sonak, Judge High Court of Bombay. I request Advocate Akshita Bhatt to present the token to Honorable Sri Justice Jitendra Jain, Judge High Court of Bombay. I request Advocate Anand Shirokar to present the token to Honorable Justice Shri Somsekhar Sundaram, Judge High Court of Bombay. I request Advocate Sapna Modekar to present a token to the President CA. To present a token to the Honorable Justice M.S. Sanklecha, Retired Judge, High Court of Bombay. Thank you. I request Advocate Shirley Fernandez to present a token to the President of the CA Goa Association, Mr. Milind Shirokar. Thank you. I now request Honorable Justice Mahesh Sonak, Judge High Court of Bombay, to introduce our speakers for today's seminar.
Good morning. My brother judges, President Pereira, President Shirodkar, senior advocates, chartered accountants, accountant tax professionals, my colleagues at the bar, and my dear fellow students. For the past 4 months, I have been deeply immersed in a deluge of additions, deductions, disallowances, exemptions, assessments, reopening of assessments, and even some bad debts. Nevertheless, I am carrying forward. Earlier, I thought that the most challenging problem was balancing a lawyer's gross habits with a judge's net income. Jiten Bhai, I was told that they call our bench as a very well-balanced bench only because you are in the assets column and I am in the liability column. But to help me in these taxing times, I have had the good fortune to call upon the expertise and the experience of our dear friend Justice Manoj Sanklecha, who a lot of our judges, including myself, refer to as Guruji. And of course, the two new outstanding additions to our bench, Justice Jitendra Jain, Jiten Bhai as we call him, and Justice Somsekhar Sundareshan, Som to me. Mind you, the three have never let me down. They have always addressed my most basic doubts, my most foolish queries with utmost courtesy and without any loss of patience. They have not once been condescending and have always tried their best to educate me. That they have not succeeded too much does not reflect on their teaching skills, but reflects entirely on my learning skills. Friends, I had read somewhere that law is the only game where the best players get to sit on the bench. Thinking of myself, I always thought that this viewpoint was wrong. But after seeing players like Manoj, Jiten Bhai and Som, I see the point in this way. Rarely, if at all, does the audience go to the game to watch the umpire or the referee. But I know firsthand how students, lawyers, chartered accountants flock to the courts and learn from our esteemed guest speakers who are here with us today. Manoj, Jiten Bhai and Som were the best in their field. They were at the very top. Still, with a commitment to give back to the society, they did not protest the sentence of being benched. In their elevations, they have added nothing to their statures, but their elevations have contributed significantly to the elevation of the statures of the benches they preside over or of which they are a part. Thank you very much, Manoj, Jiten Bhai and Som. Friends, during these taxing times, Manoj, Jiten Bhai and Som has been the best thing, please excuse my expression, but really the best thing that happened to me. Without them, their guidance and their ever willingness to share their immense expertise and experience, I was seriously considering appealing to my Chief Justice that he had better delete my addition to the tax bench. Friends, today I am in a rather piquant situation. On the one hand, I have so much to say about today's speakers, but on the other hand, we all have so much to listen from today's speakers. Speaking a lot about them would undoubtedly cut into the time allotted to them. So please make some allowances for my uncustomary brevity. Manoj has been a friend, philosopher and a guide. He carries his vast knowledge in direct and indirect taxation with grace and humility. Manoj's hallmarks are innate goodness, creative sensitivity, and an urge to do justice coupled with a dominating humility. That's a phrase used by Justice Frankfurter. I had the good fortune of sharing the bench with Manoj in my fledgling days as a judge. He was extremely helpful, extremely open-minded, and extremely unassuming. He strives to elicit the best in others, and Manoj, we are really grateful that you are here with us. Jiten Bhai is a qualified lawyer, chartered accountant, cost accountant, company secretary, and now a very overqualified Bombay High Court judge. He has practiced tax and constitutional law in practically all the courts in our country. He has taught taxation to students, lawyers, chartered accountants. He has also authored a book on the MPID Act. Jiten Bhai is also a very quiet and an unassuming judge. He carries all his academic qualifications and professional experience with humility and a very simple poise. Our institution is fortunate and proud to have Jiten Bhai as one of its judges. I am most fortunate to have Jiten Bhai by my side, guiding and helping me through these taxing times. In the short time that I have had the good fortune to know and interact with Som, he has literally dazzled me with his sheer brilliance, down-to-earth nature, and a fantastic sense of humor. Som began as a financial journalist and has excelled at that. He then became a partner in two of the country's top legal firms, and again he excelled. He then transitioned into legal counsel practice and very soon reached the pinnacle. He is an avid mountaineer and a tracker, and there is no doubt that he will scale the most incredible heights. Besides being a journalist, lawyer, and a judge par excellence, Som has made immense contribution to formulating the law and legal policies on intricate issues of security markets and market abuses. The legitimate role of SEBI as a regulator and all such matters that are vital to India's transition from a developing to a developed nation. He is fiercely independent and never even considers compromising his intellectual integrity. Som is an invaluable gem to our institution, and our institution is fortunate to have acquired such a gem. Thank you very much, Som. I thank the High Court Bar Association and the ICAI for hosting this workshop. Goa, as you know, is my home. You are all my very dear friends. So in a sense, I must confess, this is a kind of an opportunity for me to show off my dazzling and brilliant colleagues from Bombay. More than that, this is an opportunity for you and me to learn from our guest speakers' expertise and vast professional experience. May I therefore request you all to join me in welcoming and applauding our guest speakers, Manoj, Jitin Bhai and so. Thank you very much.
Thank you, sir, for introducing our eminent speakers for the day. Let us now all get up for the brainstorming sessions to be followed by our most eminent speakers. May I now request and invite Honorable Shri Justice M.S. Sanklecha, retired Judge High Court of Bombay, to deliver a lecture on the topic Income Tax Overview with regard to appeals and writ petitions in the High Court. Over to you.
Justice Sonak, Justice Jitendra Jain, Justice Somashekharan, President of the Goa Bar Association, President of the Goa Institute of Chartered Accountants, and friends. Justice Sonak, in his characteristic style of being very humble, said very good things about me, which made me wonder whether he's talking about me or about somebody else. And left me wondering whether I should have had those qualities which he perceives in me. And the last thing he said was that he's very happy to have me here so as to exhibit his friendliness with people who are experts. I only hope at the end of the lecture he doesn't disown me. There are two confessions which I would like to make before I speak on the topic. Confession number one is that I have retired as a judge more than 6 years ago. I'm not, to that extent I'm a little stale, but you must please appreciate that I'm only a starter. If you'll get a little disappointed with my speech, don't leave the hall. You have a very good fare coming after me. So never judge a book by its cover. So don't be disappointed at my speech. You have something better coming. That is the first confession I would like to make. The second is that when Justice Sonak told me about coming here, I was a little reluctant because I'm not very much into the subject now, and it's been, as I mentioned earlier, more than 6 years. But then he insisted, and then I thought to myself, in the last 6 years, nobody listens to me. So this is an opportunity which I've got where I can speak to people, and people will be forced, having come here, out of at least if nothing else, out of courtesy to be here and listen to me. So in case I do extend my time, I do speak for a longer period than required, you please stop me, because this is out of not having an opportunity to speak for the 6 long years. Because earlier as a lawyer, you have your clients to listen to you. Then as a judge, you have the lawyers who listen to you. And all this time, the only person who doesn't listen to you is your family, and they continue to do that the same. So in retirement, it becomes very difficult to express yourself. So thank you, Mahesh Sonak, Justice Sonak, for having given me this opportunity to speak here. As you all know, the Finance Act 1961 is going to be substituted by the Finance Act of 2025. By and large, I've very quickly gone through the bill. By and large, the concepts have not changed. So whatever concepts were considered important under the old Act will continue even under the new Act. What has happened is they have reduced the number of sections, they have reduced the number of provisos, explanations, because the 61 Act, to meet the ingenuity of a taxpayer, the legislature would come either with an explanation or with a proviso so as to meet a particular problem which arose because of the taxpayer's interpretation of a provision. But this act tries to bring about a complete overhaul, in the sense it makes it very clear what is to be taxed. So they have done away with the provisos and the explanations to a large extent. The old Act of 61 contained of 47 chapters. The new contains of 23 chapters. The old contained 819 sections, while this contains only 536 sections. Now coming to the topic on hand, I understand that many of the lawyers who are participating, who are attending this conference, are not into tax practice, and it is an initiation for them so as to get attracted to tax practice and take up tax practice as a regular source of practice. And I can tell you one thing, that tax practice is indeed one of the most satisfying practices, because there is no human emotion involved, and therefore you can, in any other branch of law, there is always human emotion involved, and that takes a lot of price for the judge, for the person who is adjudicating. In tax practice, it is very academic. It is, you have only the sections and the ingenuity of the lawyers to grapple with. So therefore, it is, if one is of that bent of mind, of an academic bent of mind, and not really involved, would not like to get involved in human emotions, then this is an area which you must surely look at. By and large, tax laws. So I'll be addressing some basic issues which arise, and then I go to the topic of my discussion. Tax laws are broadly divided into two categories. One is called direct taxes and the other is called indirect taxes. Indirect taxes are those taxes where the payer of the tax does not pay from his pocket. He collects from somebody and he pays. So the final incidence falls on somebody else. So it is not directly collected, and therefore it is known as indirect tax. So far as direct tax is concerned, the payer is the person on whom the incidence falls. So this is the broad distinction between indirect tax and direct tax. So far as indirect tax is concerned, we have now the GST, which alone remains. Otherwise, earlier we had excise and we had sales tax, VAT, but that all has now a thing of the past. We have GST. So far as direct tax is concerned also, we only now have the Income Tax Act. Earlier we had the Estate Duty Act, which was abolished in 88. Then we had the Gift Tax Act 1958, which was abolished in 98. And the Wealth Tax Act, which was abolished in 2015. Tax jurisprudence. Any tax jurisprudence would have following four elements in it for to be as essentials to be a taxing statute. One, it would have a subject of tax. Two, it would have person liable to tax. Three, it would have rate of tax to be collected. And four, measure of tax. So far as subject of tax is concerned, that you get from the charging section. Charging section states on what the tax is to be levied. And in this case, section 4 of the old Act and section 5 of the new Act sets out what the charging section is. Now, this is a charge on the income of a person. So that is the charging section. And income has been defined under section 224 in the old Act and under 249 under the new Act. So it is on income that the tax is to be paid. An English judge very beautifully described what would be the difference between income and capital. And I think that doesn't require, that I have to explain. He said that fruits from a tree are an income and the tree itself is wealth. So what is to be charged to tax is income, that is the fruits from the tree are to be charged. So therefore capital as such is not taxable. However, by an artificial definition, in the definition of income, the legislature has made capital gains tax liable as income. But otherwise, in the normal course, capital would never be a subject matter of income tax. That is the first thing, subject of tax. The second would be the person who is liable to tax. Section 4 of the old Act, or 1961 Act, says that income tax would be payable by persons. And persons have been defined as into four categories. Or rather into seven categories: individual, HUF, company, firm, AOP, local authority, and artificial judicial person. Now this classification is important because it is on the basis of this classification that tax is imposed. For instance, if there is a very famous Supreme Court case of Om Prakash, where an individual was also the culprit of his HUF family. In the Income Tax Act, there is a provision where you club income of your spouse or child in case they don't have enough educational qualifications to merit that remuneration which they are getting. So it is clubbed in the income of the individual, the spouse. Now in this case, the Karta of an HUF was a partner in a firm, and his wife, his spouse, was also a partner in that firm. The Income Tax Department wanted to add the wife's income to the individual's income, and the Supreme Court said no, the individual's income is different from an HUF's income. So this classification is tight, in the sense you can't, because he is the same person, you can't tax him on the ground that the Karta is nothing else but the same individual. Similarly, the artificial judicial person, so far as firm is concerned, under the Partnership Act, a firm is not a separate entity. It is only a collection of partners together known by the firm name. But in the Income Tax Act, firm is identified as a separate taxable entity, and therefore tax is payable by the firm. So far as artificial judicial persons are concerned, there is a decision of the UP High Court where they said that Bar Council of Uttar Pradesh was being sought to be charged tax, and they said that we are not persons, but the UP High Court said that it would fit into the definition of artificial judicial persons. That is a person who is not a person who has permanent existence, who has a common seat, who holds property in his own name, would be a person who is liable to tax as an artificial judicial person. That is the second element of tax. The third element is the rate of tax. The Section 4 provides only what will be charged to tax, but it does not provide rates of tax. So rates of tax are provided every year in the Finance Act which comes in, and that provides the rate of tax to be paid for the assessment year concerned. The last element is measure of tax or value. Now, what happens is that tax, these are all four elements which are very necessary before you can say that a taxing statute is complete in itself. Now, measure of tax would be the measure on which the tax is to be paid, the rate is to be applied. For example, income tax would be payable on income, but the measure would be after deducting all expenses which you have incurred to earn the income, that would be the measure on which the tax would be paid. The best illustration would be an excise case of a difference between a measure and the between the measure of a tax and the rate of tax. In an excise case in Bombay Tire International, the charge of the tax was on manufacture. However, the revenue contended that though the charge is on manufacture, the tax has to be paid on the selling price. On the first sale, the price, it should be paid and not on manufacture. Earlier, the contention of the SSEs would be that as the charge is on manufacture, all expenditure incurred post-manufacture could never be a subject matter of tax because it is post-manufacture. And some courts had taken a view that it could not be charged to tax. The Supreme Court in Bombay Tires International said that there is a difference between a charge and a measure. The measure is the quantum on which the tax would be paid. And for the purpose of arriving at the quantum, they mentioned that it would be at the rate, at the price which the goods obtain. The charge continues to be only on manufacture, nothing else. But the measure would be the price which the manufacturer obtains on the first possible sale of his goods. Before I speak further, I would like to clarify a few concepts under the Income Tax Act. One is, of course, previous year and assessment year. Now that, under the new bill, goes away. We have what is known as a tax year. We don't have this difference. So the difference would be in a previous year, assessment year would be the preceding financial year. That is the year, for example, 24-25 is the financial year. The assessment year would be 25-26. So it would be the year following the previous year. You would be paying taxes in the assessment year. So therefore, you will be earning the income for the year, financial year 24-25. And in the next year, when you are filing your return, the law applicable would be the law in force at the time when you are filing the return. That is 25-26. Now this difference between previous year and advisedly so, the bill seeks to do away with this and have only one nomenclature, that is the tax year. You still have the financial year for the purpose of computing what the income would be for that year. Then the other concept which you would face is the difference between real income and notional income or hypothetical income. Income is to be taxed on the amounts which have been received or accrued and arisen. So amounts which have been received, there will be no difficulty because you have received the amount in cash and that is the amount which you put to tax. So far as accrued and arises is concerned, that is really a mercantile system of accounting. So when you have a right to receive an amount, is that time you will register the income in your books of account, and that would be a subject matter of tax. Now many a times what happens is, though you have written that this is the income which I am going to get, but that income does not at all see the light of the day, and it is evident at the time when you are paying the tax. So the income which you have registered is really a hypothetical income. It's not a real income, and what has to be taxed is the real income. The Supreme Court, in a case called Godhra Electricity, decided this issue. In two cases, Godhra Electricity and Excel Industry. There in Godhra Electricity, electric tariff was increased. Some people went challenge that tariff, and the tariff was stayed, that increase of tariff. In normal course, this would have been taken into account as income, but that tariff was stayed. Besides staying, as the matter went on, the state government took over the Godhra Electricity Company. After having taken over, they said that the old tariffs will not apply. So for that assessment year, though they had taken that amount as income, the increased tariff which they had charged to the customers, that did not become a part of the income on which they had to pay a tax, because that was not the real income. Similarly, in Excel Industries case, that was a situation where an exporter got certain benefits like duty-free exemption scrips, advance licenses which he could import free of duty, which entitled him to import free of duty. Now the revenue's case was that the fact that you have got these advance licenses, the value of advance licenses is the income you have earned in this year. But the Supreme Court said no, it is not the income which is earned in this year, it is the income which would be earned when he exercises the option to use that advance license. Because it's not only a question of a person receiving the income, it's also necessary for any income to take place that there must be an obligation on the other person to pay you that income. And that would only arise when the person uses that advance license. So therefore that is the other difference which you will find. This is something which income tax lawyers use. These are the phrases which the income tax lawyers use very generously while arguing matters. The next important distinction is between tax avoidance and tax evasion. This is not defined in any act. However, this debate between tax planning, that is tax avoidance, and tax evasion is as old as possibly civilization. In fact, even though Holmes may have said that this is the price you pay for civilization, the minute it would have started, people would have made plans to reduce their tax implications. This entire thing of difference between tax evasion and tax avoidance, it refers to two English decisions, and they are very important for the reason that they also set out what is how taxing statutes have to be interpreted. The quote is like this. One is the case of Cape Brandy. It's a 1921 case of Privy Council, and they said in a taxing statute one has merely to look at what is clearly said. There is no room for intendment, no equity about tax, no presumption of tax. Nothing is to be read in or implied. Only the language used is to decide the scope of the section. And the Westminster case was, this is what they say: every man is entitled to so arrange his affairs that the liability to tax is reduced. There is no ignominy in reducing your tax by arranging your affairs in such a manner. Now this was in the early days of our constitution, of our country, independent India. This was applied across, in all matters, taxing matters. This was the dictum which was used, and we very strictly only went by the written letter and nothing more. This got a little bit of a change in before this is also evident. There's a very famous case of Supreme Court called Calcutta Discount Company. There are a company sold its shares to its subsidiary at a price less than the market value, and the revenue wanted to charge the tax at the market value. This was resisted by the SEC. The Supreme Court, relying upon the earlier Privy Council decisions, said that what the person has sold for is only that X amount that was less than market value, and then what is to be taxed is only that amount and not any notional benefit which the revenue thinks he must have received, or the market value. Now that was the law which consistently held the field. Till in 1985, there was a decision called McDowell and Company Limit. But this was a case where there were 5 judges. There was a minority view of Justice Chinnappa Reddy which gained currency because it was a little revolutionary and it went beyond what the earlier law had said. The facts in that case were this, that the McDowell was selling alcohol and it had to pay excise duty. The sales tax which was payable, that was known as turnover tax, was payable on the total bill value. That is not only the value of the goods, but that would also include the excise duty payable. So as to reduce the tax liability, McDowell told his customers that you pay directly the excise duty payable on this product, show us the evidence of payment, and we will give you the alcohol. So on the bill, there was the element of excise duty was not there at all. So therefore, the SEC contended that all my obligation is only to pay the bill amount, aggregate of the bill amount as my turnover, as a measure for my turnover tax. This Justice Chinnappa Reddy, while giving a minority view, he said that according to him, tax avoidance is not permissible. And the reason he said for this was, he said that it is finally, by planning, one cannot deprive others of what is due to them, because by reducing your tax liability, you are really putting the burden on somebody else, and therefore it is not permissible. And he took a view that the English decisions which the other courts rely upon are really a matter which have buried deep in England also. While the majority took a view that there is nothing wrong with tax avoidance, but what they said was, and on that basis, what they said was that you can certainly do tax planning so as to reduce your tax liability. But what you cannot do is a sham transaction, a transaction which is a colorable device to reduce your tax liability. That is not permissible. What is permissible is tax avoidance by legitimate means. And that was the majority view. And though McDowell lost, but the majority view was lost because of Justice Chinnappa Reddy's eloquent style of writing, and also the fact that he came up with a new definition of what tax avoidance would be. And please remember, that was a socialist era, so it did take a lot of currency. People felt that yes, this is how it should be, and the rich should not, because in those days, those who paid taxes were the very rich. Majority of us didn't have that sort of money. So the general public, it appealed to the emotions of the general public. Then there was a decision called Azadi Bachao Andolan, which was again not a decision where a person, it was a public interest litigation, not a person who was involved in the matter who had filed this. This was with regard to a treaty between India and Mauritius. Now that treaty, these are what are known as double taxation treaties which are entered between the countries, so that tax is payable only in one country and not in both the countries. If 2 countries are involved, if the individual concerned is involved in 2 countries. So there, it was challenged on the ground that there was this treaty which said that the tax would be payable by a resident of Mauritius on capital gains made by him. Now, the requirement of a residence of Mauritius was only a tax residency certificate from a Mauritius government. Now, the revenue wanted to break open this corporate shell and wanted to go beyond the apparent tax resident, and find out who is really the person behind this tax resident. And the Supreme Court said that no, they reaffirmed the view of the majority in McDowell's case and said that it is this, one has to go by what is stated. this tax planning is completely permissible and one cannot break the corporate shell or find out what the objective of the person was in doing this particular thing. This was followed by the very famous decision of Vodafone. Now this Vodafone case was actually a case which is lost. The facts of the case are lost. It was really a TDS case. It was a case where tax deducted at source was not paid. It was a case where Hutchinson sold its shares to Vodafone abroad. So Hutchinson held some shares in a company in Mauritius. That company A again in turn was a holding company of company B in Mauritius, which in turn held shares in Vodafone India. Hutchinson had not paid the TDS on the amount received from Vodafone had not paid the TDS on the amount paid to Hutchinson. When the matter came here before the Supreme Court again upheld the Azadi Bachao Andolan case and said that no, this is tax planning and this is permitted. It cannot be that you must bring into tax what you feel is the real intent and purpose. But what they again reiterated in that case was, they put in two tests. One is substance or form test. So you must really look at the substance of the transaction and not at the form in which it has been put. One is if the substance is not to evade, there is a difference between tax avoidance and tax evasion. But if the substance is to evade, then certainly the revenue can go behind what is apparent and tax the person. The other was look at test. These are the two tests which the apex court evolved in that case. And the look at test was that you look at the entire transaction. Don't look at a part of a transaction to determine whether or not there has been an evasion of tax. Now on that basis, they again reiterated that it should not be a sham or it should not be a colorable device. Now this, after Vodafone came, the government brought in to set right what they perceived was injustice to the revenue. They brought in what is known as General GAR, which is known as General Avoidance Agreement of Tax. And that has got into force in 2017. But in substance, it really reiterates the earlier system of what is to be taxed is the substance of the transaction. You have to look at the substance, and if it is not a sham, then it is, and then they have specified for few transactions which would be considered to be a tax evasion exercise. But otherwise, this distinction between tax evasion and tax avoidance continues. There are a couple of things which, before I come to my topic for today, you see, income, once it is earned, the person liable to tax, there are again 5 heads under which each income has to go. It could be either income from salaries, it could be income from house properties, it could be profits and gains of business, it could be capital gains, and it could be income from other sources. So this sets out the entire gamut of from what sources the income, because each of these are sources of income and they have to be taxed. Now, this is provided under section 14 of the old Act and section 13 of the new Act. So there is no change in the basic concepts under the old Act and under the new Act. There is one concept called 14A, which is really when you claim an expenditure in respect of earning an income which is not a part of a total income. Then the question was whether such an expenditure, because the company has incurred that expenditure, whether such an expenditure could be allowed as an expenditure in determining the net income. This section 14A disallows that being done. So therefore, if you spend some income to earn and you don't earn any money, or or the income which you earn is exempted, then there would be no question of the expenditure incurred in earning that income being allowed as an expenditure. So to that extent, your income would go up. This, the best illustration for this would be if you borrow money and don't use it for business purposes, give it to your friend. on a friendly loan, and you say that it is only a expenditure which I have incurred in the course of business because I am otherwise doing business transactions with him, that would not be allowed as an expenditure. In fact, there is a very famous case called SA Builders case to get over this entire thing, and they came up with what is known as a commercial expediency test. Now, if you expend some amount to earn an income, in this case, what had happened was funds were borrowed, and it was given to a subsidiary. But this subsidiary at no interest. The question was whether giving this money to the subsidiary was at all in the interest of the business of the company, which had taken the money on interest and had given it to its subsidiary. The Supreme Court said in that case that the test applied is to be the commercial expediency test. That is, you have to look at what the reason is. If for instance, if the subsidiary company is going to do business with what money I have advanced, and that business is a 100% subsidiary, and whatever money is gained out of that business is going to result in dividend income for me, then that would be something which could be justified on the business expediency test, and that could be allowed. This is one. The other provision which comes in is clubbing of income, where income of a spouse or income of a child is included in the income of the individual. There is only one section in the entire Act which does not permit clubbing of, and that is section 5A of the old Act and 10. In Goa, because of the community of income, husband and wife income is divided into two. So it is the only state where there is no clubbing. That's the only great feature of this Act. So if a husband earns 15 lakhs, he will pay only tax on 7.5%, and his spouse will pay a tax on 7.5%. It would not be a question. So that is because of the Portuguese law of community of property, and this continues even under the new provision which they have got in as section 10. The new bill, they have got in this provision. In fact, a little aside. In fact, when I was a judge, we used to have these applications for seniors gown, and there was a minimum taxable income which the person had to return so as to be considered for being bestowed the gown. Now it so happened that the persons from Goa had applied, their income was less because of this 50% going out of their income, return of income, and hence they were not being considered. And it was then when this was pointed out, then it was realized that this is an injustice which is being done to the Goa bar. And then we used to double whatever was filed as his return from profession, and then that would be the criteria to decide whether or not, among others, of course, that cannot alone be the criteria. And according to me, personally speaking, that should never be the criteria. The source of income, the quantum of income to decide the efficiency of a man as a lawyer. Because there are other, income could also, one should also appreciate that if you are practicing in labor law, your income would be very insignificant. And you may be a very good lawyer. And if you are practicing in, say, tax matters, your income is substantially larger than what a labor lawyer would earn. And that is because it is finally the revenue which pays for that also, because whatever expenses you incur on a tax lawyer, you take it as an expenditure. So, in any case, that is again an aside. Now, there is a new section called 15BAC in the Act, which gives an option to follow the old regime or to follow a new regime. Now, in the new regime, the question of deductions and all are not available. You file your income tax return, and on that basis, they would charge you to tax under the new regime. There are no deductions. Well, under the old regime, there is that Chapter 6 says that you get various deductions. You must appreciate that, in the old regime, when you have these deductions, the objective was that income should be channeled into particular areas of community living. And therefore, to incentivize people, they had provided that for housing projects, if you give particular amount, you will get some deduction if you are constructing houses. So it was a policy-driven thing. Now, under the new regime, you have both. You could just pay your tax on the basis of what you earn, or you can have this option. But you have to exercise that option once, and you are stuck with that option. So that is the other thing which is there. The last thing which I would like to mention is what is known as arm's length price. Arm's length price is a price at which you arrive in view of this opening up of the economy, you have multinational companies who operate in various countries. Now these multinational countries operate, their objective is always to reduce the tax burden in a country where the tax rate is high and to shift their profits to a country where the tax rate is low. So the normal system of doing it is either to inflate the price if you want to transfer the profit from the other country to this country, or depress the price when you want to transfer the profit to that company abroad. Now to get over this, what the Act provides for what is known as a Chapter 10 procedure in the old Act, and it is there also in the new Act. So in this procedure, what they do is they arrive at the arm's length price. There is a specific officer, transfer pricing officer, who specialized in this area, and he arrives at the arm's length price. What the price would have been if two people unrelated to one another would have entered into a transaction, and that would be the price at which the tax would be assessed. There's a completely different system. But, I mean, that is the concept which one must bear in mind while these are the concepts. Now, coming to my topic of appellate jurisdiction. I only hope I'm not extending the time which has been. Is it, out of courtesy, please don't tell me that it should continue. If I continue for some time, when you think that I'm extending, please tell me. The appellate jurisdiction under the Income Tax Act is under the old Act is under Section 260 capital A of the Income Tax Act. The new bill provides under 365. It is identical. There is no change in the wordings of the sections. Now, under 260A, the High Court entertains appeals from the orders passed by the tribunals. But the appeals which come to the tribunal do not deal with the universe of orders passed under the Act. It deals only with some of the specified orders which can be entertained in appeal. There are a large number of orders for which no appeal is provided to the Income Tax Appellate Tribunal, and consequently no further appeal to the High Court. In those cases, one has to file a writ petition if one is aggrieved really. And you meet the tests which are required for a writ to be entertained. But otherwise, it will be only in respect of those appeals which have been disposed of by the tribunal where an appeal could be filed to the High Court. Now in the High Court, when an appeal is to be entertained, besides appeals from the High Court, there is another authority called Board for Advanced Ruling, which has come in substitution for what was Authority for Advanced Ruling. Now, Authority for Advanced Ruling was earlier a very high-powered authority, having a retired Supreme Court judge as its president. And that would give where a person wanted to invest money into India. Before he decides to do that, it was open to him to go to this Advanced Ruling Authority to determine what would be the tax impact, so that he could plan his affairs whether it makes sense or not to invest in India. And that ruling of that Advanced Ruling Authority would only be binding upon those two people involved, that is the revenue and that person who has made an application. It would have no presidential value, it would have no value for the others. But that, unfortunately, the government has replaced with what is known as a Board for Advanced Ruling, which consists of officers of the revenue. And for that they have provided for an appeal to the High Court from its ruling. But unfortunately, there is no such provision found in Section 260A or 263, which sets out what orders would be appealed. Now, so far as appeals are concerned, before the High Court, there are a couple of important things. First is that the appeal must give rise to a substantial question of law. Appeal must give rise to a substantial question of law. It must be filed within 120 days of the receipt of the order. The third thing is that it must necessarily the High Court is obliged to formulate that question of law and decide that question of law. So therefore, the SSC who files an appeal or the revenue who files an appeal must formulate a question of law. If the question of law is not formulated and if High Court does rule on that, then the order itself becomes bad. In fact, there is a recent Supreme Court decision in the case of Shivraj Gupta, CIT versus Shivraj Gupta, where the Delhi High Court had ruled on a particular dispute between the SSC and the revenue without formulating a case of law, and it ruled in favor of the SSC. When the matter went to the Supreme Court, a very recent decision, in fact, 425 IPR, took a view that in the absence of a question of law being formulated, because the tribunal, the High Court did not have jurisdiction to decide this issue. So it is a sine qua non that a substantial question of law should be formed before the appeal could be filed to the tribunal, to the High Court. The other issue is what would be a substantial question of law. Now, the substantial question of law, it stands settled by virtue of section 100 of CPC. And the famous case is Santosh Hazari's case, where they said what would be a substantial question of law. In effect, it says it must affect substantial rights of the parties, and it must be a question which has not yet been decided. So therefore, when an appeal comes to the High Court, it will formulate a question of law. The question of law which is formulated must be substantial, it must be real, it must not be academic. There must be a debatable point of law. It must not be just the point of law. Mere point of law which is not debatable will not make it a question of law. There should be two views possible on that question. And the question formulated must not be a new question. It must be a question which has not been decided. It must be a question which has not been decided, either by the High Court or by the Supreme Court. But that leads to a very interesting thing. What happens is in this section talks about two things. One is that 262A says that an issue which has not been determined by the tribunal or an issue which has been determined wrongly. The question is whether an issue which has not been argued before the tribunal, whether it could be argued for the first time before the High Court. And the Supreme Court has taken a view that cannot be argued. Only what can be argued is questions of jurisdiction. If the person does not have jurisdiction, then the fact that you have not argued that he does not have jurisdiction will not bar you from raising it at any stage. And therefore, Bombay High Court has also taken a view that only on jurisdiction they have gone and examined the matter when the issue was raised was jurisdiction. But it essentially has to be raised before the authority. Other issues have to be raised before the authority, before the High Court can decide on the issue. This leads us to a very interesting question: is what happens when a particular issue. Normally, what happens is in a tax matter, because there is this requirement of certainty of law, that everybody should know what the law is. Though the principle of res judicata does not apply to tax matter, but the courts are conscious that everybody will be so planning his affairs depending upon the decision which the court has rendered. What happens is that at times you don't have a decision of your parent High Court, the court which is hearing a matter, but you have a decision of another High Court on the same issue. The question was whether the court which is hearing the matter, which was not, is it bound by the decision of another High Court? And it doesn't have a decision. If it's a decision of our High Court, then one is certainly bound by that and one would have to follow it, unless one wants to refer it to a larger bench. But so far as other High Court decisions were concerned, earlier the Bombay High Court used to take a view that if it is something which is a possible view and it doesn't shock the conscience of the court which is hearing the matter, then it would normally follow that view, because in All India Act, we must try and apply the Act similarly all over the country. However, in a case called Thane Electricity, for the first time, the view was completely reversed. Our court took a view that so far as Supreme Court decisions are concerned, they are binding on everybody. But so far as High Court decisions are concerned, on analyzing section 268, took a view that the High Court under that section is obliged to independently apply its mind, and its decision will be binding on all SSCs within the country. But that has changed the terrain to an extent, because now Earlier, otherwise, you had a decision from any court that would have been a gateway to success. I mean, it would have without much difficulty. But that is no longer true. You have to independently establish, and the other side gets a chance to re-argue the matter and also point out how the earlier decision was not correct. The only distinction being this, that where there is a constitutionality has been set aside, whether say somebody has challenged the constitutionality of a particular provision and that has been upheld, and that question, though question of constitutionality will not be there in appeal, but the question goes to the root of that section, because if it has been held to be unconstitutional, then there could be no debate on that question. In such cases where a statute has been, where a provision has been held to be unconstitutional, it applies across the board to all and sundry. And this our court has taken a view in Godavari Saraf. The other thing which I mentioned is about there being no res judicata in tax matters, and the contest is between res judicata, no res judicata, and certainty in law. The Supreme Court has given decisions on both sides, so it's not very clear. But so far as our court is concerned, what happens is that if there is a decision which is already covers the issue, and if an SSE or the revenue does file an appeal, notwithstanding the fact that the decision for the earlier year, say on the same issue, the High Court has given a verdict, then the SSE for the next year would continue to follow that decision and say that because this is certainty in law and I will follow it like this. Now, in view of the Supreme Court not being very clear on this aspect, the Bombay High Court had evolved a procedure whereby you are entitled to file an appeal. However, it must be either your appeal memo must set out or you must file an affidavit setting out the reasons which justify filing of an appeal. There could be, every assessment here is different. There could be change in the provision which would result in your filing an appeal. There could be a subsequent decision of a Supreme Court which changes the interpretation to be given to the section. Now, in such cases, once that is filed, then you certainly entertain the appeal and decide the appeal on its merits. Another important aspect with the appeals of the tribunal is that many times after the tribunal passes an order, there is a rectification application which is filed. Now, once a rectification application is filed, it could be either allowed or disallowed. If it is allowed, your 120-day period would start from the date the rectification application is allowed. But if it is disallowed, then your appeal will fail only on account of limitation. The rationale being this, that when the rectification application is allowed, your order on the rectification is really the order which has disposed of the appeal. But where the rectification application is disallowed, then the original order stands as it is. So the wise thing to do is to file an appeal earlier from the earlier order, then move a rectification application. And in case you succeed in rectification, then you can certainly withdraw. But it would be unwise to wait for the result of the rectification, because that may result in the complete end of your grievance. This is about so far as appeals to the High Court are concerned. Then there is the question of writ jurisdiction. As I pointed out earlier, not all matters are subject of appeal. There could be matters which could be a subject matter of for which no appeal is provided. Now, in those cases, the normal principles of administrative law would apply, and you could file a writ petition like in any other case, and the whirlpool exceptions have to be followed before challenging a decision which is, for example, there is a provision called 264 under the Income Tax Act. Now, that is a provision for revision. The powers of the assessing officer, the orders of the assessing officer are revised by the Commissioner of Income Tax, either suo motu or an application by an SSE. Now, many times those are decided against the SSE, and then the SSE challenges that order. Now, that challenge to that order could be on the ground that he has passed this order without giving me the normal exceptions in the whirlpool case, that the breach of national justice, that is, avoid the decision-making process contrary to the statute, then enforcement of fundamental rights. The orders against which no appeal is provided are essentially, one is commissioner of, where then you can file writ petitions. One is commissioner's powers, orders and revision. The other is when an appeal is filed to the commissioner appeals from an assistant commissioner's order, there is no power of stay in the commissioner appeals. So you apply to the assessing officer that you stay the demand till my appeal is disposed of. And against that you go to the jurisdictional commissioner. But at times they don't grant a stay. Then that is the time when people move the High Court and saying that there are decisions in my favor and you ought to have granted stay. That is the second class of categories of cases. Then there are orders of the Central Board of Direct Taxes. Now, Central Board of Direct Taxes is a body constituted under Indian Revenue Act, but it is the highest body under administering the Income Tax Act. And it is they who issues circulars and also ensure, the objective of this board is to administer the act and ensure that the act is uniformly applied to all. But there are cases where, and how important it is, it would be known by the fact that if there is a circular which is issued by the central board taking a view on a particular issue and that is in favor of the SSC, then the revenue is bound by that. The revenue cannot say that we will contest and view not in conformity with the view of the Central Board of Direct Taxes. So that's how important it is. But then there are cases which arise where you have failed to file your claim and exemption within a time frame. Then you apply to the central board that in view of certain contingencies or certain exigencies of circumstances, I could not comply with the time limit. Then they grant an order stating that you could your time limit is extended. It is again specific to the particular SSC. Now against those orders also people do challenge. And then challenge is also when the central board has also the power to transfer the assessment from one assessing officer to another assessing officer. Now that, if it is not correct, that is also another area where the court challenges, or where the SSCs do challenge. The another area, largely the area is of reopening of assessments under section 147 and 148. But like in any normal writ petition, what has to be shown is effective alternative remedy is not available. There are no disputed questions of fact. It is not an academic question. It's a finding of fact which is perverse. It is a policy. It's not a policy decision, not prohibited by statute, and there has been no delay in moving the court. And lastly, that my conduct has been such, that the conduct of the person approaching the court has been such that it is clean, that he has not suppressed any facts, and you must also have justice on his side. There are on that basis, it will each will depend on the order which has been passed by the authority. Whether or not, the one thing which must bear in mind is that a writ court will not convert itself into an appeal court. So therefore, the challenge should not be like an appeal, because, and this is so far as the writ court is concerned, it's a discretion which is exercised by them not to entertain an appeal where there is an alternative remedy, or not to entertain a writ where there is an alternative remedy available. But that is a self-imposed restriction. In the facts of a particular case, if they feel injustice is done, they would certainly interfere. Another two things really before I come to another two small things. One is a rectification application, whichever is filed. You cannot re-argue a matter in a rectification application. It has to be something which is apparent from the record. That alone you can point out. So nobody will, even in a high court order or a tribunal order, they will not allow you to re-argue the matter if you file a rectification application. You have to point out only that the decision, say, has missed a Supreme Court decision or binding decision, and therefore it calls for rectification. Another important thing is that many a times when you file your return of income, you have not made a particular claim. The question which arose was that whether an assessing officer which an income return has not made a particular claim, whether the assessing officer can entertain that claim. And the courts have taken a view an assessing officer cannot entertain such a claim. He has to go by way of return of income alone. However, the appellate authorities, the Supreme Court has now said that nothing prevents an appellate authority from entertaining a new claim and deciding the matter, because the section only restricts the assessing officer from doing entertaining a claim which has not been made in the return of income. That more or less completes what I had to say on the appeal and on the writ petition. Only one last thing, and then I end for the day. So far as reopening of assessments are concerned, this reopening of assessments under the old law was divided into 143(1) and 143(3). Now, 143 under the old Act, when you file a return, either they would accept the return without examining it in detail, and that would be a return called under 143(1), where the return of income was examined in detail and an assessment order was passed. That was known as 143(3) order or scrutiny assessment order. Now, under the old Act, when there were different periods of limitation for 143(1) and 143(3). Now, if you have 143(3) order, then you could not open the assessment beyond a particular point, and for beyond a period of 4 years. When it was 143, you could go up to 6 years, and the assessing officer had necessarily had to have reason to believe that income escaped assessment. Now, the statute itself did not provide, but there was a Supreme Court case called GKN drive shafts, which set out the procedure to be followed. Once in the old system, I am referring to the old system only to show the contradiction which I will refer to in the new system. In that system, under that procedure, once a reopening notice is called, the assessee is asked to file his return of income. The assessee can call for the assessing officer before issuing a notice and to record his reasons why he believes or why he has reason to believe that income escaped assessment. Now, that could be a subject matter of challenge before the assessing officer and saying that you have no reason to believe. That could be accepted, rejected, and then that could be a subject matter of, if you don't accept his rejection, it could be a subject matter of a writ petition. The new Act has done away with this provision of reason to believe, the distinction between 143(1) and 143(3). However, the GKN drive shaft exercise, it has specifically provided under the new provision. So you have, before a notice for reopening is issued, the jurisdiction to reopen an assessment under the new Act is when the assessing officer receives information which the reason to believe has been done away with, which suggests that income has escaped assessment. He would, before issuing a notice, issuing a reopening notice, he would issue a notice to the party. That would be responded to, and the information is now so wide that they have defined what would be called information. Even an audit which has been taken place and as a consequence an audit, some queries have been raised, that could be an information on which a notice could be issued. Earlier the writs were filed that the assessing officer would have no reason to believe, because the entire exercise was done earlier and it doesn't give him the facts on which he is basing his claim will not lead to any reason to believe that income has escaped assessment. So therefore, the challenge now is only very limited, and it can only be that this is a change of opinion. Earlier, you could always contest change of opinion by saying that under 143 complete scrutiny assessment was done, and therefore, if it was beyond, he couldn't do it beyond 4 years. Now, there is no distinction to reopen between 143 and 141 are done away with. However, the point is that it could still be challenged on the ground that he has already applied his mind. When it was a change of an officer who comes in that seat and he thinks there's a different view, then it would not give jurisdiction to reopen an assessment. Of course, these provisions are still very nascent, new provisions, and court-made laws will develop over a period of time. I think that's all I have to say, and thank you for a very patient hearing.
Thank you, sir, for your insights, telling us in brief the elements of text and throwing light on various important decisions, and also letting us know how Goa is having a unique feature when it comes to paying of income tax. So let us take it very positively that tax is a fine for doing something right. We will now have an interactive session. For that, I call Advocate Amira Raza, Standing Counsel Income Tax, Official Liquidator and Government Advocate to conduct this interactive session.
It's a pleasure to have you here. Sir's encapsulation of the Income Tax Act into 45 minutes reveals his brilliance and his mastery of the subject. May we have questions from the audience? Either you've understood everything or nothing at all. On behalf of my colleagues at the bar, may I request, please could you elaborate on tax avoidance, tax evasion and GAR provisions?
Would it be GAR is a statutorily recognized provision in the Act which came into force in 2007, consequent to the Vodafone decision of the Supreme Court. The GAR provisions are really aimed at what I would call tax evasion and not tax avoidance. Tax avoidance would essentially mean tax planning within legitimate means provided under the Act. Tax evasion would mean going beyond the Act and doing something which no honorable person would do so as to reduce your liability to pay tax. And GAR provisions have now statutorily prescribed various transactions which would be considered to be hit by, would become in the fold of tax evasion and would not get the benefit of tax avoidance. That I think would be
The crux of it, yes. We are grateful for that. Any questions from the audience? Yes, please.
Good afternoon, sir. So my name is C.A. Vinayak Tumarkar. I am representing the Goa branch. So I have a question regarding the appeals. When an SSE seeks an appeal, when the stakes are high, naturally as a right of appeal he goes into further appeal, right? But when he wants to stay on that demand, the stay is not automatic. It's a right. It's objective to the officer to decide the case on the merits of the case. So, according to you, why is it that when the SSE has a right to go in a further appeal, even despite paying the 15% pre-deposit, still the officer has a case where he can deny the stay? Is there any case law or judgment which says that when the SSE goes in for a further appeal and he pays that 15%, then the assessing officer has to grant him a stay?
There's a very famous decision called Kamalakshi, which lays down the doctrine of precedence. There are two things here. Once the under the statute which provides for depositing 15% and 20%, the stay comes into force. And once that has been done with the appellate authority, the statute itself provides for a stay, and it will not be open to an assessing officer in that light to try and recover the balance amount. That is one, 15% and 20%. Two is, though the statute does not provide for an appeal to the Commissioner of Appeals, or a stay application to the Commissioner of Appeals, yet there is a decision of the Supreme Court in Mohammed Kunni's case, where they said that every appellate authority has an inherent right to stay the orders of the subordinate authorities. because it is in interest of the final order which is going to pass. So one could certainly do that. But to answer your specific question, is that the assessing officer cannot do that, and if he still insists and issues letters, then the writ is the proper forum to go and see that he stops issuing.
And there are many guidelines which are laid down by the High Court, Bombay High Court in the case of KEC International. They have said how to deal with a stay application. Oftentimes, assessing officers, CITs, they reject it cursorily without hearing the party. So the High Court has set down certain guidelines that they have to be heard. High-pitched demands have to be treated in a different way. So these are the parameters within which stay applications have to be treated. There are CBDT circulars and guidelines also which have laid down certain percentages on which stay has to be granted. So, any other questions? Yes.
So this is Advocate Paragraph. So the earlier section 148 GK and knife shops was followed. From 1st April 2021 it is amended, though it is not bodily engrafted in 148A. What would be your view? The scope for interference is wider or narrower now after 1st April 2021 for the High Court in a writ petition?
I think it would be narrower. It would be much narrower. Because one, that reason to believe goes, because otherwise there was two-pronged attack. One was that he has no reason to believe on the material which he has. And the second was there is a change of opinion. The change of opinion still remains. The reason to believe is, though one could still argue that the information should suggest income escaping assessment. And therefore the information which is gone would not even remotely suggest that any income has escaped assessment. But reason to believe is certainly on a higher pedestal than suggestion.
Perhaps non-consideration of the reply to the show cause notice under 4 subsection.
Yes.
Thank you.
One step further in that, 148 cannot be taken as a mini trial before the stage of 148A cannot be treated as a mini trial before the stage of 148. And there is an exception which is built into it, where a notice for reopening can be directly sent to an assessee even if the provision of 148A exists. And there are certain exceptions which are carved out in 148 itself, 148A itself. Yes, please.
I'm Pranav Naik, Chartered Accountant. When an assessment order is framed by an assessing officer, the course of action available to an assessee is an appeal which goes to the first appellate authority as Commission of Appeals. But if the assessee has a view that the assessing officer could not exercise jurisdiction at the first place itself, can he come in with the High Court with a writ because the jurisdiction was not possible, because he already has an alternative course of action available before CIT appeals? So can a writ be filed in that case?
A writ could be filed, but it will all depend on the facts of the case. Writ court could certainly exercise. But what would weigh with the court is there is an alternative remedy available. And if this very relief could be availed of in an alternative remedy, why should the court exercise? So there could be a case which causes tremendous hardship. So it could be with regard to a hospital or charitable institution. Then in its discretion the court may exercise, but not as a matter of right. I mean appeal task, because the courts, as it is, the courts are so full of matters which are pending for long, and there are shortage of judges. I mean, these matters, wherever alternative remedy is available, they would be slow to interfere.
Yes,
Sir, what would you say about the current faceless assessment regime and the pitfalls of it?
To my mind, it's a disaster. Because any assessment which has to take place, any adjudication which has to take place, there has to be an interaction. Because if you have a faceless assessment, then the SSC has no occasion to really meet the objections which he has. And here the cure is worse than the disease. They got in this to ensure that the assessing officers don't make money on the side. They don't discriminate between different SSCs. But that does not work on the ground. I mean, so therefore the cure is worse than the disease. I mean,
eventually the appeals will grow.
Correct, appeals will grow. Absolutely.
Any further questions? And now there's a tussle between the FAO and the JAO, and that issue is now before the Supreme Court.
am CA Prashant Jain. My question is relating to delay in filing appeals. We can obviously need to file a condemnation petition. So is it condemnation petition, acceptance or rejection? Is there any high court guidelines, etc. wanted to know?
It cannot be a universal guideline, but you could, if there are justifiable reasons, then the court would certainly interfere. There are no, not to my knowledge, if there are any reasons on what, because it will depend from case to case basis. It cannot be. It will depend on case to case basis and what cause has been made out for condonation of delay. There cannot be a universal cause. Then they would have provided for extended time itself.
Thank you.
Thank you so much. Thank you, sir, and thank you, ma'am. We acknowledge the presence of Honorable Justice Madam Nivedita. I request Advocate Manaswi Shirodkar to present the token to our Honorable Justice Nivedita Madam. Okay, we move on to our next session now. I request and invite Honorable Sri Justice Jitendra Jain, Judge, High Court of Bombay, to deliver a talk on the topic Working on Income Tax Matters. Over to you, sir.
Good morning, friends. I take this opportunity first of all to thank the people of Goa for shaping my career, and I attribute today whatever I am to a great extent to the state of Goa. In fact, my first brief I got by default because Justice Sonak was elevated and Entertainment Society of Goa couldn't find anybody to take risk with. So they had to take a risk with me, and that is how the Goa journey started. And thereafter it was never looking back. And especially the chartered accountants and lawyers of Goa who gave me so much love. I never felt that I was an outsider. And your president of the Bar Association, whenever I used to come to Goa, he used to tease me by saying that I am son-in-law of Goa. Now coming to today's topic as to how to work on the tax matter. The first thing, it is a commercial transactions, whether you take indirect tax or you take a direct tax or you take a transaction of import or export. All these are commercial transactions. And one thing which I had always practiced, although some of the school of thoughts felt it is against the ethics or the conduct, is that whenever I used to take up the matter, I used to go to the client's premises or the factory to see how they are doing the business. Because whenever you are representing a tax matter, it is very relevant for you to understand the transactions. Sitting in the chamber in the conference, it's not possible to understand the transaction, how the business works. For example, if you have to argue whether a particular activity constitutes manufacturing or production of an article or not, sitting in the chamber, having in the conference, the bar charts and all will not help you. Because when you are going to stand in front of the court, you have to explain as if you are the person who is doing that activity. And for that, the only way to learn is to go to the shop floor. We had a matter when I was doing my CA article as to whether from eggs to chicken is a production or manufacturing of an article or thing. For that, we had to literally visit the poultry farm and find out how this process happens. And it's such a scientific process from egg to 1-day-old chicken. And then when you understand that process, you are in a better position to put across your point to the court as to how it is a manufacturing or production of an article. Similarly, in the Income Tax Act, we have various rates of depreciation for building, plant and machinery. Now, whether a particular building can be treated as a building eligible for 5% or 10% rate of depreciation, or whether it is a plant eligible for 25 or 33%. Now, that you will be able to argue only when you have visited that building and find out for yourself whether that building satisfies the functional test laid down by the Supreme Court for it being treated as a plant. So we had an interesting matter where these poultry farms, all these poultries are housed in a poultry building, and the issue was whether we should get depreciation on building or it as a plant and machinery. So the first impression will be that it is a building. But when we went there, we realized it is not a normal building in the sense which we generally understand. But it is constructed in such a way that it increases the production of the eggs. And that is how the functional test criteria was satisfied. The point which I am making is that you have to understand the business by going to that particular place where your client is doing the business. If you are having some matter of a gold jewelry business, then you should understand how this business of gold is done. Every business works in a different fashion. So unless you know how the business is done, you will not be in a better position to argue in front of the court. And when you argue, the court will ask various questions because they are also interested in knowing what exactly you are doing. So if you have visited the factory premises of your client or the business unit where he is doing, you will be in a better position to explain. After having done that, the second most important thing is you have to understand how that transaction is reflected in the books of accounts. Because many times the courts will ask certain questions, and to answer that, the knowledge of how these transactions have been entered in the books of accounts will be very crucial. So far as chartered accountants are concerned, they are experts in that. But so far as lawyer friends are concerned, they will have to make an attempt as to call upon your clients to explain, to show how the accounting entries are done. Because that will give you a clue how to put forward your case. So knowledge of how the transaction is entered in the books of accounts of an assessee is very, very important. Similarly, if it is a GST matter, then whether a particular transaction is a good or it is a service, how it is reflected in the books of accounts will be crucial. So you have to know the entries, how the GST returns are filed. If you are doing, or if you have a matter of customs or import or export duty, then how the shipping bills are prepared, how bill of entries are prepared. So that basic documentation you need to understand so that the foundation is made for you to put up your case. Now, tax is one of the act which changes every year. Therefore, you will find people who are doing tax are exclusively doing tax. And the speed at which it changes is so fast that you have to either keep yourself updated or you will be outdated. Now, when any matter comes and a particular section is involved, you need to start studying the section from the day the section was born till the day with the year which you are concerned, and also the year in which you are going to argue the matter. So the birth, the year with which you are concerned, and the year in which you are going to argue the court before the court will be crucial. And when you compare the evaluation of that section from the day it was born till today, you will find how the changes have happened in that particular section. Why that section was changed over a period of so many years. And that will give you and equip with you a better position to argue, to explain the history of the section, so that you can put forward your proposition that there was a change from X to Y, and because of that X to Y, you are making this particular submission. So we had one matter where I appeared before the tribunal, and before the High Court, Mr. Sardesai appeared. It was a case of agricultural income. And when we started studying the definition of agricultural income incorporated in 1922 and how it changed over a period of time. That coupled with the fact of the local laws. So then we could come to a particular conclusion which we were trying to develop, and that helped us in getting a success at the High Court level. So how the section was born, why it was born, how it changed over a period of time, why it was changed, and what is the position today will help you in interpreting the section today. When it comes to GST law, Senvet credit rules. So you need to know what were the Senvet credit rules under the old regime, under the service tax or under the excise. Compare it with the today's input tax credit valuation rules. That will give you an insight as to whether you should rely upon the case laws which were prevailing at that point of time, whether they are today also a good law, how the input credit tax rules have changed. So that will help you. So a law may have changed from excise to GST, from VAT to GST, but the basic concept, if it is same, then you can certainly rely upon those particular judgments. Or if you need to take some other view, if the revenue is going to rely on some judgments under the old law, then because you have studied how the law has changed under the excise from GST or to GST, you will be in a position to distinguish if those judgments under the old act of excise or VAT on input tax credit will not apply because of this particular today's new law. So the journey of a section is very, very important. Now, direct and indirect tax devolves or develops or evolves more by precedents, circulars and notifications. when it comes to indirect tax, customs, GST, excise, VAT, they are more circular and notification driven. When it comes to direct tax, it is more of a case law driven and less of a circular notification driven. Now, case laws are very important because whenever you prepare for any matter, you may look out for case laws which are in your favor because of the shortage of time which you have or the less assistance which you get. But in that process, we miss out what are the judgments in favor of the revenue, which revenue is going to. Therefore, to be updated on the case laws, whether in your favor or against you, is very, very crucial. You may be updated till yesterday, but if today you are going to argue, you have to be updated till today, because today morning you may get some judgment which goes against you, and in the court you will be taken by surprise. So case laws updating is very, very crucial. I understand all this, what I am going to say requires lot of time and efforts, because either you have to accept the quantity or you have to accept the quality. That choice lies with the advocate. Now, case law driven is very crucial because, again, the law in income tax changes so fast. So, assuming a particular case law is in your favor or against you, but because of the change in law subsequently, that may not be relevant. So, unless you are thorough with the case law and the section, the birth of the section and the journey of the section with the case laws as of today, arguing any tax matter will be very difficult. And in my 1.5 years of experience on the bench, I can tell you that this is the handicap which as a bench we find, that both the parties are not updated with the case laws. And we don't rely on the case law cited by either of the parties, but we go back to the chamber and we do our own research, and that time we realize that at least one of them should have pointed out, because that makes our job easier. Because if we have to do research and we don't have the team and the assistance which you people have, but then that is how it is, because ultimately whatever we write, we are going to sign it, not you people. So we have to take up that responsibility whether you cite or don't cite. And recently I'll just share one experience. There was a matter which we heard, myself and Justice Sonak, on 144C, time barring. Both the parties cited one or two judgments, and then when we did the research, we found a judgment which is neither reported in ITR, taxman.com, but we found that judgment reported in Kerala Law Times, and which was directly on the point. So now with this software, of course, you will have to curtail how many softwares you can do the research with, but you will have to try multiple, at least couple of softwares, to see that nothing is missed out. Because if you have some judgment which may have been reported in Kerala Law Times and which is in your favor, but if you have missed out, then that is a big loss for you. And invariably we have seen that even senior counsels, of course, because of their time and all, they are not in a position to cite the latest. Juniors also, they are too busy than the seniors. So this is where I would expect that a lot of assistance is called for from the bar so that our job becomes easy, and it is in the interest of you party. Now tax is something where it need not, a person specializing in tax should not have the knowledge of only tax law. Because ultimately the tax laws is married to various other laws. So you need to have, if not in-depth knowledge, at least when the matter comes to you and from that transaction you realize the other laws are involved, at least have a working or in-depth knowledge of the section of that other laws which is affecting your transactions. So suppose there is a transaction of capital gain and there is something on 53A of the Transfer of Property Act. Now we have, of course, we have seen tax lawyers. They are very good at tax, but they somehow miss the in-depthness of section 53A provision as to under what circumstances 53A is applicable. There are so many circumstances where provision of 53 doesn't get attracted. So for that, study of section 53A is very important. See, you may be specializing in tax, but the bench doesn't specialize in tax. Bench consists of judges who have more of the other laws knowledge than the tax knowledge. So they will just bounce upon you on section 53A because they are very good at 53A. So at that point of time, if you cannot counter-attack them, don't attack us, but you have to be prepared with the reply on section 53A. And for example, especially for Goa, now just one of the last matter where I got a chance to argue in Goa, which went on for 3 weeks, was on deemed dividend income 222E, and as Justice Sanklecha pointed out 5A, in Goa the moment you marry, your wealth goes down by half. So we were arguing a provision where Mr. A was holding shares to the extent of 20%. But because of, and there is a parameter under 222E, that if you hold 20%, then you are a person interested, substantially interested, and if you give a loan, then it becomes a dividend. But because the assessors were from Goa, we were arguing that because of the Portuguese Civil Code, that Mr. A is not the owner of 20%. He holds only 10%. 10% is owned by the wife. So at that point of time, for 3 weeks, I got a chance to study whole of the Portuguese Civil Code, which otherwise I would have not. But because I had a policy of doing only one matter a day or one matter at a time, I could afford that. So the knowledge of Portuguese Civil Code, when I studied it, it helped me in arguing that why the 20% bar given in the Income Tax Act and as per the Companies Act would not be applicable in the state of Goa because of the Portuguese Civil Code. Ultimately we lost. The matter is in the Supreme Court. But the point which I am making is the knowledge of the other laws is crucially very, very important. Doing only tax law knowledge will not help you. Or let us take a case where the transaction is of some financial instruments. Now every day the finance world is growing so fast and various new types of instruments are evolved by the financial experts. So to understand that taxation of the financial instruments, you should have at least, or you should, when the matter comes to you, you should have the knowledge or study what are the SEBI regulations which governs that instruments, or what are the other financial regulations which governs that transaction. That will help you in arguing the tax matters. So the knowledge of other laws is equally and crucially important when it comes to arguing any tax law. Now coming to the pleadings. Now, of course, the trend is faceless. When you had an interaction with one-to-one with the officer, it is easy for you to explain, and it is, if there are some queries, the officer will immediately ask. But now with the transition to faceless, you have to ensure that all the basic facts are put in black and white at the assessment stage only. Because whatever you are going to put, the facts I am saying, is a foundation for the matter when it travels to the higher authorities. And with this faceless, every document you have to upload. So the scope of inserting any document at the appellate stage is very less, because it is easily verifiable whether you have uploaded this document at the assessment stage or not. So that is something very good so far as the uploading electronic assessments are concerned. But today, although faceless may not be a good alternative, and it has failed to achieve the objective for which it was inserted. But in faceless, you don't know what is going on in the mind of the person who is going to assess. The complicated transactions of financial instruments of Bombay are given to the assessing officer who is in some other parts of the country. And because he is from that other parts of the country, the chances of his understanding such a complex transaction is very less. But as of today, the faceless stands. So it is for you to put everything in black and white as if it is a treaty or the thesis on the transaction. Because then it is easy for that person to read and understand. The reason again why you have to put in black and white at the assessment stage itself is when the matter travels to the higher authorities in the High Court, we generally ask the question, where have you pleaded this? So if you have put your case or the facts, all facts at the assessment stage itself, your lawyer will be in a position to tell that this is the point which was put forward to the assessing officer. Now, grounds of appeal. In income tax and the tribunal rules, there is a provision that the grounds of appeal have to be in brief. That is so far as direct tax is concerned. So naturally, we just write 3 lines. The officer erred in doing so and so. But when it comes to the High Court, judges will ask you, where have you taken this ground? So now you are in a catch-20 situation. The rule provides that the ground should be brief, and the High Court judge is asking you, where is this particular ground? So to overcome that, what you should do is that in your written submissions, you have to raise in your submissions all particular arguments which you think is necessary. So at least from the submissions you can tell the court that this is the point which was raised before the authorities. So your submissions have to be very detailed, more so because now we are transitioning towards faceless. Even tribunal, they are planning to have it faceless, so all the more reason for you. And if you have everything in writing before the lower authorities, when it comes to High Court, it becomes very easy. If some points have been missed out or has been misinterpreted by the authorities, there is something for you to show to the court. This is the correct position which I have stated in black and white. Because if you say, no, this was orally argued, we don't go by oral arguments. We go by whatever is written. So pleadings have to be very, very crucial. When it comes to indirect tax, it's totally different. The pleadings, the appeal pleadings in indirect tax is like submissions in the direct tax. So the pleadings by filing the appeal under the indirect tax is so exhaustive. So it is at that point of time you have to ensure that everything is pleaded in the appeal memo itself. Now coming to the intertwin of the various sections. Now when you are dealing with a particular section, the general tendency is that we read only that particular section, we will do research only with respect to that particular section, and then our focus is only on that particular, with the blinkers on that particular section. But that may not be the correct approach. You have to think which are the connected sections with which you are concerned. Because when you will try to find out the connected sections, you will find the relationship between those two sections, and you will be in a position to answer, or you make out a point as to because of this particular relationship, the argument which you are making is correct. Now if you had only examined that particular section, then this would have not been possible. Many times same phrase is used in different sections of the Act. So therefore, if you want to know that how that particular phrase has been interpreted in the other sections of the Act, so unless you know those other sections where this phrase is used, you will not be in a position to lay down or help the court to lay down the law. So, and now with this software, it is very easy to find out as to under which different sections of the Income Tax Act this phrase is used. And then it is very easy for you to find out the case laws, and then find out whether those sections has any relation or is in pari materia, so that you can use those particular sections. And here I would just share one matter when I was practicing. There is a section 140 capital A which says that when you file your return, you have to pay your self-assessment tax. So prior to 89, there was section 140A and I think subsection 5, where penalty was provided if you do not pay the self-assessment tax along with the return of income. That section remained as it is. Then 89, the scheme was changed and we got section 234A, delay in filing the return, 234B, if there is a deferment or default in 90% of the tax, advance tax payment, 234C, where you have not complied with the quarterly mandate of payment of advance tax. Even after 234ABC, the officers were levying penalty under 140A5 because that was the section at that point of time. Now, when we studied that matter and we found this particular 234 ABC having introduced from 1989, because prior to that 234 ABC interest deferment and all was not there. So we got some clue as to whether 140A5 penalty can at all be levied after the insertion of section 234 ABC. We did a lot of research, but we couldn't find a single case law. Then we went to the memorandum explaining the provisions of 1989 Act where 234 ABC was introduced and why it was introduced. As I said, the birth of the section and the journey of that section. And we found out that section 234 ABC was introduced to do away with section 140A penalty. And then from that particular argument we developed, and the tribunal took the view, yes, after 1989 you cannot levy penalty on. So this could have been possible only because we studied the interplay of the section. Otherwise it would have not been possible. So it's not only that particular section. You have to relate 144C. 144C subsection 13 provides that within 1 month the officer has to give effect to the DRP's direction and pass the assessment order. And it says notwithstanding anything contained in section 153. The general limitation for passing the order is under 153. Now, whereas 144C13 says it overrides 153. So we were trying to test the argument of the revenue as to whether it could be treated as a mandatory limitation provision or is it a directory provision. Now, because the phrase used was notwithstanding anything contained in 153, he has to pass the order within 1 month from the end of the directions which he receives. So that gave us a clue. Why 153? Then we went to 153 and we realized what was overridden is the time limit given in 153, but not the nature of the limitation which is engrafted in 153. So it is a mandatory provision. So the point which I am making is that we have to correlate the connected sections for laying down or developing the law. The last thing which I would like to share is that on the case law, even if the Supreme Court is in your favor or against you, don't go to the court or to the tribunal on the premise that now it is an open and shut case. You study that particular, if it is against you or favor, whatever it is, you study even the Supreme Court judgment minutely and see whether it could be made applicable to the facts of your case. Prima facie, you may feel it is in your favor or it is against you. The reason why I am saying is the classic example is of section 11 of the Arbitration Act, appointment of arbitrator. But even that section traveled from 2 judge to 3 judge, 5 judge, 7 judge and so on. So the law has to be developed, and we will be able to develop the law only when you come out with some arguments on whether the Supreme Court is the correct law or not a correct law, or is it applicable to your case or not to your case. So even if you feel the Supreme Court may not be correct, we are bound by it, but at least you will get a chance to lay down the law by carrying it forward. So it has to be developed. The law has to be developed and it has to be progressive. It has to keep itself updated with the current scenario. So even if there are judgments in your favor or against you, don't go on the premise that it is an open and shut case. You study well whether it applies or it can be distinguished on the facts of your case. And the history has shown, that even a slight change in the fact will make you out of the Supreme Court judgment or the High Court judgment. Now when it comes to the presentation before the tribunal or in the High Court, you have to make your point in the first 5 minutes. Before you start, just give in 2 minutes or 5 minutes the bird's eye view of what exactly is the matter, so that the bench knows how to proceed further. And once they know that this is the bird's eye view of the matter, it becomes very easy for us to lay down the law. But if you take us roundabout, then it becomes very difficult for us to assist either of the parties. And for that, I would suggest that make a 2-page note, which we have been following in Bombay, which lays down, which gives you the basic important dates and events and the propositions. It should not be long, but at least 1.5, 2 page. So that becomes, it is for your good, because that will help us to dictate the order better. Because if that assistant doesn't come, then it becomes very difficult for us, and then the sufferers will be either one of the parties. Whenever any questions are asked, we have seen the tendency is to deflect that question and go to the other point. But my personal advice to all of you, that I understand when there is a flow in which you have made up your arguments, and if that flow gets interrupted by the bench, you lose the rhythm. But whenever any questions are asked by the bench, ensure that you address that question first before you follow your rhythm. Because the moment you try to postpone answering that question, it gives a wrong signal to the bench. The intention may not be to see that our attention get diverted. The intention may be that you want to go in a particular flow. But your answer will help us in understanding your flow. Therefore, whenever any question is asked by the tribunal or the court, ensure that you answer that particular, and if you do not have an answer at that point of time, be candid enough to say that I will check up. The reason what we have experienced is that when we ask the question, the reply comes prompt, yes. And when we ask them where it is, show us, it is not there. Then an impression is created. And once that impression is created about a particular lawyer, then then it's very difficult to change our mindset. So just see that that particular thing doesn't happen. I think I have covered most of them. If you have any questions, you are most welcome to answer. Ask me. I can stand and answer. Vinesh, where is he?
Thank you, sir. You have beautifully explained in a simple manner the procedure on working on income tax matter. Because most of us here believe the hardest thing in the world is to understand the income tax. We have for this session Mr. Vinesh Pigle, a renowned CA, to conduct the interactive session.
Thank you. So I must say, it's for us grappling with preparing these appeals or even briefing the council is a matter of a challenge. The very lucid, simplified manner in which you have taken it sectionally for us to be able to digest this, I think every practitioner will be, lifelong obliged to you. I would request a loud round of applause, please. I've had the good fortune and honor of briefing sir on a couple of matters, and I know what he has preached here, he practices to the T. So before I have a few questions of my own, but the floor is open. If anyone in the audience has any questions they would like to address to sir, we'll take those first.
Welcome, sir, to Goa. My question here is, we are facing one practical issue when we are doing sale deeds, and this has come to me from my union colleagues as well. Now, my question is on the deduction of TDS. Now, if it is a sale deed which is done by an Indian national, there is no issue. We deduct 1% TDS. But when we are doing a sale deed with respect to a person holding an overseas citizen of India card, then there is a different slab provided for deduction of TDS. Still there is no issue. But my issue is this, what we are facing. that an overseas citizen of India who is holding an OCI card but who is residing in India and is asked to deduct tax, who is also filing his returns in India, who is asked to pay TDS at the same rate or slab with respect to individuals who are overseas citizens of India. So my question is, how do we resolve this issue? Because I just complete myself. One of the suggestions given by the sub-registrars is that we should obtain a tax residence certificate from the ITO. Now, this is practically sometimes very, very difficult. So, I would just request if your lordships could guide us on how to go about with this issue and how do we tackle this issue.
See, if you are the person who is going to deduct the TDS, you don't have to pay anything from your pocket. You have to deduct from whatever 100 rupees you are going to give him. So, and you have to protect yourself, because if there is a short deduction or no deduction, the consequences of penalty, prosecution is on you. So you would be in a position where without any interest in this transaction, so far as the monetary is concerned, you will have to face the consequences. So in such case, the conservative approach, so far as the person paying is concerned, the seller is concerned, is to deduct at a higher rate. This is a practical thing. But suppose the transaction, because of this particular thing, the transaction is not going through. Then in that scenario, and you are interested in getting the transaction go through, then I would advise that you have to take an undertaking, or you have to ask from an undertaking from him that he is a non-resident, OCI, and all those precautions, and then come to a conclusion that whether you need to deduct at a lower rate or higher rate. If after getting all those details, if you still feel that higher rate is required to be deducted and you still deduct from the lower rate, then I don't think the tax department will not be justified in taking action against you. But if the buyer gives you a proof, or he doesn't tell you about his OCI, he only tells you I am a resident, then take that particular certificate and then deduct at a lower. So at least you have taken the precaution which a normal person would have taken. So at least that can help you in facing the consequences of the tax authority. That is what I feel would be the better approach.
Just one more question I'll add to this. How far is the grant of a tax residence certificate justified for the production before the sub-registrar to show that even though I am holding a OCI card, but I am a resident of this country and I am paying taxes, and deduction of tax at a lower slab, which is as applicable for resident Indians, would be justified. I only want to know what is the justification for grant of this particular tax certificate.
See, the TRC certificate is given by the country, foreign country. So it is based on that.
Even here we are
here also. So if that is given, then that is a sufficient precaution so far as you are concerned. Because that is a certificate, and that is exactly, of course, the controversy in Azadi Bachao Andolan was a TRC certificate of a Mauritius tax authorities. But same ratio would apply. If that tax resident certificate is there and you have acted upon it, then that is a sufficient safeguard for lower deduction of TDS. But if you are a seller, I would always, if you are a buyer, then I would always say that take a conservative approach. Because once the transaction is over, the other party will never cooperate. So it means you who will, the purchaser who is failed to deduct TDS, has to face the consequences. So indemnity you can take it, but then again enforcement of indemnity is a very tough task in India. So that is how we will have to go ahead.
Yes. One more question. My question is on the centralization of taxes. Centralization of taxes, where the center has got a right to, they can centralize your taxation. Now, how far the discretion of the revenue to centralize these taxes and the challenge before the High Court by way of a writ, what would be the parameters for interference of the High Court when it comes to challenging an order of centralization of taxes? If your lordships could just guide us on this.
What exactly do you mean by centralization?
Centralization, in one of my matter, what was happening was the SSC, although was here in Goa, his which you call the circle for filing taxes and all that was Goa, and I think of course I am not much into that, but the Bangalore circle is what is considered for Goa, I think. But there was an order which was passed centralizing his taxes to New Delhi.
No, that is centralization of cases.
Yes.
So what happens? Many times a search is conducted on, let us say, Mr. A. In his search, the revenue finds the transactions of various peoples across the country. Now, if all different officers across the country are going to examine those transactions, then every officer likelihood of taking some view or the other will be. And even the person who is going to assess Mr. A, for him also to understand the transaction, it is in that interest for the collection of revenue that the cases of those connected people are transferred from the respective state or the place to the place where that person was searched, so that the officer at X place where Mr. A was raided, he can understand the transaction and interlink the transaction for arriving at the correct assessment state. So if it is a case, it will all depend from facts to facts. But generally, whenever the centralization of cases happens, the department does a thorough work and there is a procedure they follow. So normally the interference of the court will be very, very narrow. And earlier the argument was there that if I am in Goa, how can I go to Delhi? My chartered accountant is here. But now with this faceless and all, it's not necessary for you to travel. So that argument also goes. And even if that argument would have been available, the balance will be more towards the centralization because it is for correct assessment of all the parties who are connected with that particular person who was searched. So the scope of interference will be very, very narrow.
Thank you.
Thank you, sir. Are there any further questions? Yes, sir. Subsection 8 of section 154, which talks about the time limit of 6 months for the assessing officer to pass an order, either accepting or rejecting. Is that a directory provision or a mandatory provision?
It is a directory provision. Like in many of the provisions you have appeal provisions, that the appellate authority will dispose of the appeals within 6 months, 1 year. So it is only to give a psychological pressure on them to see that they do it. But according to me, it will be a directory. Of course, it gives the consequences in the sense that it says that within 6 months he either has to allow or reject. It doesn't say that if the 6 months are over, then your application will be deemed to have been allowed. So wherever the legislature wanted to have the consequences of not complying with the time limit of allowing the application, they have provided. So there, in that case, one can say it is mandatory. But in this 154(8), it will be a direct route. But still, we have cases where even after 154(8) insertion, the rectifications are not being carried out. But so we do quote that provision and direct the officers to do it immediately.
So, in what remedy does the SC come to? In terms of the writ or?
They can come by way of a writ for the limited purpose of mandamus, saying that you direct the officer to decide this application which is pending for so long.
Thank you.
So, what do you think are the most common procedural lapses when the appeals are filed before the bank? I just wanted to ask you, what are the most common mistakes what the professionals do while they appeal to your benches? The most common errors while appealing, if you can throw some light.
When it comes to tribunal appeal, the grounds have to be very brief. We had an experience when I was practicing where the grounds ran into many pages, and then tribunal used to direct the assessee or the revenue that your grounds are argumentative, they are not in accordance with the tribunal rules, so you modify it. So you have to go by the rules. If the rule says brief, you have to make it brief. Second thing is that take all possible grounds in the appeal itself. If you miss any grounds, then there is an application of additional ground, then it has its own discretion of the appellate authority, so you are at the mercy of someone. So when it comes to asking, ask everything under the sky so that you can give up something. But if you have not asked, then you become at the mercy of somebody. When it comes to High Court appeal, of course it will be drafted by the lawyers. So questions of law have to be properly drafted. The question of law should bring out the controversy. And we find many times, with all respect to the revenue, especially in Bombay, that those questions are not properly drafted. So the question, because we will first see the question. So if that question appeals to us, then we can make up our mind further whether to admit or reject. So drafting questions of law is very, very important. When it comes to indirect tax, you ensure that all your submissions and facts go along with the appeal matter. And when it comes to direct tax, ensure that all the submissions you make are put in black and white after the filing of the appeal, whether it's the commissioner appeal or the tribunal. One more thing which I want to say, that many times on one particular issue, you will have 3-4 arguments. But the tribunal feels that no, now this one argument, Bombay High Court is there, so I'm going to decide in your favor. So we also don't bother. And let us say that Bombay High Court gets reverses subsequently, and the revenue comes up in appeal. Then at that point of time, if you tell the court, I had 3 other points which the tribunal has not considered, but then the question asked will be, where have you argued that? If you have not argued, then you cannot argue that thing before us. So always in that scenario, what I used to do is that I used to tell the bench that you decide on this because of the High Court judgment or whatever it is, but you mention that so far as the other arguments are concerned, they are not going into it because of this. So that at least in future, you are protected if the law gets reversed.
I think there are probably quite a few more questions, but we are constrained by time, so we'll seek your indulgence if you conclude.
Thank you.
Thank you, sir. You can clap a little harder because you don't have to pay tax for your clap. Moving on to the last next session, I request Honorable Shri Justice Somsekhar Sundaram, Judge, High Court of Bombay, to address us on the facets of market abuse and financial sector regulations. Over to you, sir.
Good afternoon. Am I audible? Good afternoon. Thank you for having me here. It's a pleasure to come here. My dear brothers, Justice Mahesh Sonak, Jitu Bhai, Sister Nivedita, and Justice Sanklecha, whose intellectual bandwidth is so refreshing and inspiring. I'll try and live up to the standards set earlier today by the two earlier speakers. I think Mahesh said that Justice Sanklecha would be the appetizer and you had the main course. I'll try and be the dessert, though we're just before lunch, so please bear with me and I'll try and keep it crisp and short. I just want to say, while we were discussing what to cover today and what approach to take, I was quite wondering how in depth do I go, what kind of an area review do I give of the area of securities law. So I thought I'll start by asking a few questions. You could just raise your hand. How many of you trade in shares on the stock market, secondary market? How many of you have these mutual fund investments? A much larger segment. So broadly, you do understand what the securities market is about and how the transactions in the securities market can impact value. So I try and approach from that perspective and speak to all of you as practitioners. I'm very happy to see that the Bar Association and the ICA have come together because both tax and securities, by legislation, the practitioners include lawyers and CAs. So at the bar, you get to hear lawyers and chartered accountants, and therefore some facets which chartered accountants are prone to do and some facets which lawyers are prone to do fall in this intermixture when it comes to practicing in this area. So I want to begin with a fundamental theme that contrary to popular belief that we are a sovereign socialist secular democratic republic, but our constitution actually captures the power of markets. And I'll make this good. It's a bit controversial, but I'll make this good. Markets, because markets are a barometer of valuing an asset. Markets go to a lawyer who's good, markets go to a CA who's good. Markets decide if somebody is delivering value for the price you pay for the perhaps reduce the fan speed. So when you look at the Constitution, one fundamental principle in the Constitution is that unless something is positively prohibited by validly made law, it is permitted. So human ingenuity is wide open. You can do what you will as your human mind tells you to, unless validly made law intervenes and places reasonable restrictions on your fundamental rights to do various things. So free speech, for example, very often people don't look at advertising as free speech, but actually advertising or commercial speech is integrally part of 19(1)(a). It's a free speech. So unless there is validly made law that intervenes, there can't be a restriction on that fundamental right. So in this area, very often when during my practice days, compliance officers would say, show me where is it permitted. And I want to say that's a wrong question to ask. The question to ask is, show me, is it prohibited? And sometimes there's no comment on chartered accountants, but very often the approach would be that show us where it is allowed so that we can look at whether industry risk, others are taking the same view. And you have to remind yourselves that you have to ask, show me whether it is prohibited. Absent the prohibition, all acts of human ingenuity are permitted. That's our constitutional safeguard in our republic's constitution.
Which is why I say that markets and the force of markets and the power of our constitution are aligned. But equally it's recognized that markets are not a panacea for everything. Markets fail. Where there is a market failure, regulation comes in. And essentially regulation is a corollary to say market failures have to be addressed by validly made law. For that validly made law, there is a legislative framework. That framework enables making of a regulation, and that regulatory intervention is what you see in various dimensions, partly in tax law, significantly in securities law. The other facet I want to table is when it comes to securities law, you have to think with a completely opposite perspective as to how you think about tax law. Like if two views are possible, the view that favors the SSC would be taken in tax law. When it comes to securities law, being a regulatory legislation, being ameliorative in that sense, a legislation which is meant to curb a particular mischief. If more than one view is possible, the view that suppresses the mischief and furthers the remedy has to be taken. So there is a greater play in the joints. You can't really look at just the letter of the law. And you have to look at what is the purpose of the law and interpret the purpose of the law. Let me give an example so we'll make it clear. Insider trading law. Insider trading is about benefiting from asymmetrical access to information. A person who's an insider to a company has asymmetrical access to that company. So if he trades and profits from that access to that information, the law is meant to prohibit it. The letter of the law would say, no insider shall deal in securities when in possession of unpublished price sensitive information. But let's say you are in possession of positive information. You know that the company is going to post very good results, but you have an exigency for which you need to sell shares. When you seek to profit from good news which is yet to be published, you would buy before the rest of the market. But you sold shares. So that would not be insider trading. And it took a litigation in the Abhijit Rajan versus SEBI case all the way to go to the Supreme Court. Despite concurrent findings, the regulator would keep saying, no, you are in possession and you traded. My regulation says this, so you are in violation. Leaving aside whether the information itself was price sensitive or not, it was found that the information was not price sensitive, but even if it was price sensitive, the character was positive information and not adverse information. And what you did when in possession of it was a sale and not a purchase, and therefore you not profit. So I'm giving this as an example to see how the law can be molded sometimes. And you have to look at the purpose behind the law while interpreting the letter of the law when it comes to securities law. Another example I want to touch upon is there was a little bit of discussion about GAR, about anti-avoidance regulations. The securities regulatory framework always had an anti-avoidance rule. The section 12A of the SEBI Act in fact says no any contrivance or a device aimed at circumventing something that's prohibited in the law is also illegal, and that's an offense. So this act had GAR principles already. And therefore when you structure transactions, to try and overcome what you would perceive as a conflict with securities regulation, you can't wear your tax advisor's hat. You have to wear the hat of what is the mischief that is sought to be remedied. I'll give an example again to make this good. We had a case which is ultimately decided in Rakhi trading versus SEBI, where SEBI versus Rakhi trading rather, because in the Supreme Court it was SEBI that was in appeal. All of you are chartered accountants. Many of you are chartered accountants, and all of you know what happens towards the end of the year. Come March, you want to see how do you adjust your accumulated losses or your profits. How do you adjust your losses on securities and gains on securities? So party A executes a put option with party B, or trades in an option with party B. Let me not complicate it by put and call. You trade with the index being valued at say 100 at 12 p.m. at 12 noon. At 12:10, the same two parties do an opposite trade at 50 at the index value of 50. So one party suffers a loss from this arrangement, another party gets a profit from this arrangement, and you adjust value outside. And this is often done for tax planning. And this is an area of interplay between tax law and securities law as well. And the argument was you could never manipulate an index unless the trade is a manipulation of a securities price. It is not a manipulation under securities law at all. The Supreme Court said no, you are actually carrying out an unfair trade practice. It's an unfair trade. When you trade in the index first at 100 and then 10 minutes later at 50, you don't really believe in that either of the values that you ascribe to it. That sends a price signal to the market, and that's an unfair signal, and therefore it's a manipulative device even in the securities market. And this is again an example that I thought I'll give, and I'll come to the structure of the laws in a minute. Then I think I'll spend a little bit of time on the SEBI Act and how it came about and the structure and scheme of the Act. Securities regulations are all framed under the SEBI Act. The SEBI Act came in 1991 through an ordinance and then through an Act of Parliament in 92. But the broad construct of the Act is to create a regulator which would be a licensing authority for a range of service providers, merchant bankers, brokers, sub-brokers, mutual funds, etc. They get a license. Your ICAI for a CA is SEBI for these professionals. But there are facets of the market which doesn't necessarily involve a licensed service provider, like you and me trading in the market. So those trades, if they are manipulated, there are regulations which impinge ordinary citizens who are not regulated by SEBI. Their conduct is also regulated by certain regulations. And those regulations are, for example, the prohibition of fraudulent and unfair trade practices in the securities market, popularly called the FUTP regulations, and the insider trading regulations. A Hindustan Lever or a Reliance or a Tata is not regulated by SEBI. They are manufacturing companies, but their securities are listed in the market, and that those securities are traded in, and therefore there is a connection to the securities market. And these two regulations are what come up very often in your areas of practice. Now there are four types of intervention that a regulator can make. There is a generic remedial intervention under sections 11 and 11b, where a regulator can issue such directions as it deems fit in the interest of the securities market. It's an extremely wide statement, extremely wide provision, and regulators are prone to argue that if we can send you to the moon, we can send you to the moon. Because if that's in the interest of the market, that's all we have to show. Then there are punitive provisions, which are monetary penalty under Chapter 6A. There are multiple sections which penalize specific acts of misconduct, and a generic section saying where no other penalty is provided for, it would be penalized under that section. Now these are civil penalties, so the standard of proof is preponderance of probability, not beyond reasonable doubt. Though they are penal, they are civil penalties. And therefore the test would be, what would a reasonable man say likely happened in the facts of the case. The third is against registered market intermediaries, which is disciplinary action, suspension of license, cancellation of license. You'll often hear that a mutual fund has been asked not to float new schemes or its license has been suspended. So these are actions against registered market intermediaries. And the final Brahmastra is the section 24, which says any breach of any provision of the Act or any regulation made under the Act is a criminal offence, punishable with 10 years imprisonment or fine or both. And the compounding section says only those offences which are not punishable by imprisonment can be compounded. So that's an area which will be dealt with by constitutional court someday. But this is the scheme of the regulatory muscle power that has been given to a specialized securities regulator to be able to deal with abuse in the securities market. Now this model is replicated across all financial sector regulators. So you have the IRDA for the insurance market, you have the Reserve Bank for the banking sector, you have the PFRDA for the pension funds. And this is the model of legislation across all these areas of financial sector regulation. So the question really becomes, is this a valid methodology to regulate the financial sector? You'll have the same service provider forming different entities just to be regulated by that regulator. Let's just for an example say an ICICI will form an ICICI Securities, register it with SEBI and give you broking. It will form an insurance company, register it IRDA and give you insurance. It will form a bank which will give you banking service, it will form a pension fund unit which will be regulated by PFRD and manage your pension money. The service provider is the same as an economic entity. The consumer is the same householder who's got investments in shares, units of mutual fund, in PFRDA, etc. The abuse of the dichotomy of the sophistication between these two parties would be identical in each, but the regulatory action is fragmented across multiple regulators. And a mis-selling, if you sold an insurance product without being told how much of it in the first year is going to the pocket of the insurer, as opposed to you selling a mutual fund unit, where there is a deep regulation of how much commission can be taken by the fund in the first year. There is a dichotomy, and this is what is called a regulatory arbitrage. Parties will arrange their affairs in a manner that will let them get the maximum out of it. So this arrangement of affairs begs the question, if the legislative framework itself is fragmented, which enables abuse by fragmenting activity across different regulators, does it call into question the need for a comprehensive financial sector regulator as opposed to having fragmented regulators? So we had a commission called the Financial Sector Legislative Reform Commission, chaired by Justice Sri Krishna, where we drafted what was called the Indian Financial Code, which should make regulation a central legislative framework. But obviously each regulator is so entrenched in its respective turf that the regulators would never be very willing to let this sort of a reform happen. Every regulator will say we are so unique that we know how to run this sector and therefore don't merge us into one common regulator. So the redressal of grievances is different across each regulator. The mis-selling is the same across regulators. The penal intervention against that is different across regulators. And this is something that one needs to wonder whether this is something that is consistent with the third largest economy in the world, which is a very sophisticated market leader, etc., etc. So we need to introspect as a group of practitioners. How do we influence lawmaking to ensure that this sort of quality of regulation is commensurate with who we are as a real market? Again, speaking about markets functioning, as a market we are the third largest economy in the world. So we have to ask ourselves whether our laws and the way in which we practice our laws is commensurate with being the third largest economy in the world. So, under these two bodies of law, the FUTP regulations and the PIT regulations, the PIT regulations, the Prevention of Prohibition of Insider Trading regulations, which I spoke about, the very simple principle is do not seek to profit from asymmetrical access to information, inside information, which we call in our market unpublished price sensitive information. Other markets call it MNPI, material non-published information. These are the two simple principles. Now the FUTP regulations define fraud in its own way. Now look, if you just look at the definition of fraud, fraud as defined in the Contract Act has one structure. Fraud defined in company law, if you look at 447, 2013 Act, is another structure. Fraud in the FUTP regulations is the third structure. And it gives you illustrative types of fraud, and embedded in that would be inside information, not relating to a company, but relating to conduct about securities in a company. So you are a large institutional owner, you told your broker you want to sell 3% of a particular company's stock. This is very valuable information. What is the information? That there is a buyer for 3% or there is a seller for 3%. And the broker profits from that information. He calls his other clients and says, hey look, there's going to be a demand for 3. You buy now. When I execute the 3, the price will go up, you sell then. This is an abuse called front running. You run ahead of a trade that is meant to be done. There's no inside information to the company. There's inside information to the dealing in the shares of that company, which is in the possession of a shareholder and his broker. So this is another form of an inside information which is abused. So there are various types of such fraudulent transactions which are listed in the FUTP regulations under Regulation 3. But there is a generic provision in 3.1 which says you shall not carry out any fraudulent trade practice or unfair trade practice. Now the phrase unfair trade practice is not defined at all. So then that again gives judges and courts a lot of play in the joints to decide what is fair and what is unfair. And that can lead to enormous litigation. In fact, in the Rakhi trading example that I gave, I was representing a stockbroker who had in fact complained to the stock exchange and to SEBI saying, look, people are trading at completely divergent prices. Within minutes of the two trades, do something about it. Of course, the broker was also penalized, saying, oh, you failed to prevent that trade, and the broker won. And the Supreme Court eventually said those trades are unfair. They may not be fraudulent. They may not defraud the price discovery for the index, because the index is so huge. It comprises 50 stocks. It is not possible to manipulate 50 stocks. Even a trade, the example I gave, will not impact the value of the index. So it won't have an effect. But your trade was unfair because when you dealt with it, you did not believe it to be true. You did not, when you said the index is 100, you didn't believe it to be true. 5 minutes later, when you said it is 50, you did not believe it to be true. So this conduct is an unfair conduct, and therefore that was brought into the facet of unfair trade practice. So this again opens up a complete vista, and these are areas that you need to think about. And I thought while talking about market abuse in the securities market space, I should also touch upon market abuse in the competition law space. Competition law again is about validly made law to intervene in what is otherwise totally free for all in the marketplace. So in competition law, you have to look at whether competition is genuinely competitive or is it a manipulation of the competition. So you have two types of agreements that are interdicted in the competition law: vertical agreements and horizontal agreements. What is a horizontal agreement? 5 people in a market who are to compete with one another, they are meant to kill each other and thereby give value to the customer, are actually colluding with one another and saying what will be the price for our services. So counsels, if you say in the mentioning market, for mentioning we will charge for a full fee. And suppose you all agree with one another, for every mention I will charge a full fee. The customer is struggling. The litigant knows that no matter who he goes to for mentioning, he has to pay a full fee. That would be a horizontal agreement, which is market abuse. And some lawyer who is willing to break it and says that I will not do this, I will charge what I am, he is a fair competitor. So this is an example of a horizontal agreement which is interdicted in competition law. A vertical agreement is where you put in conditions. A supplier supplies to a manufacturer supplies to a distributor. They are counterparties to a contract and they should be bargaining to get the best against the other. But if they collude, suppose you say, unless you buy from my stockist, you will not get to distribute in this region. That would be an example of a vertical agreement which is violative of competition law. I just thought I'll place this here because as practitioners very often people tend to make you overawed about what is so special. It's such a specialized area, it involves economics. I would like to demystify it and say it's all about common sense. Economics is actually a behavioral science. Don't think of economics by looking at derivative numbers and formulae. Those econometrics, leave that to the mathematicians. But we gain the lost ground on economics as lawyers and chartered accountants. Economics is nothing but human behavior. All human conduct is driven by primarily 2 elements, greed and fear. You create a bundle of incentives and disincentives using greed and fear, and that product is called legislation. So does the legislation give you enough incentive to do something or refrain from doing something? Like you take something as simple as pollution in Delhi. I'm surprised to see the haze in Goa as well. I was hoping to get fresh air in Goa. But if you look at what is causing that pollution, is the cyclical nature of crop harvesting causing that pollution. You have to create a bundle of incentives or disincentives which tackles that problem. That would be the legislative answer to pollution. But if you say, if I catch you burning your field, you will be liable for imprisonment of 1 month. What you're doing is burdening an overburdened criminal justice system. You have to pick him up, you have to do a charge sheet, that magistrate has to have time to conduct a trial. He may eventually go to jail, not go to jail, the quality of the investigation may be poor. Fear does not drive virtue all the time. you have to look at how greed can be harnessed to drive virtue, and that's again something that these regulatory provisions keep tinkering with. So when Justice Jain speaks about how you have to keep catching up with case law, in this field of the law, you have to keep catching up with the regulatory law itself, because the regulator often tends to say, show me a problem, I'll write you a regulation. So forget judges writing case law, which you have to catch up with every day. The regulator does case law, does regulatory provisions, which keeps changing, which brings me to my next subject. What is the law on lawmaking is an area that we have to deeply think about. We empower regulators, which are bodies corporate, to write subordinate law. Those regulators have a governing council, they have a governing board, that's the lawmaking body actually. Because remember, all regulators like SEBI, IRD, RBI, this is the only regime where the three pillars of state, the separation of powers principle, is actually by legislative design broken up. Where the legislative arm, the executive arm, and the judicial arm rolled into the same regulator. The penalty is not imposed by a civil court, the penalty is imposed by an adjudicating officer, like in tax law, who is a member of the system, who is a part of the organization. Now, are there Chinese walls segregating the executive arm and the regulator from the quasi-judicial arm and the regulator? Is a question you need to think about. How would you like your adjudicating officer to be briefed in private by the prosecutor? How would imagine that happening in a criminal court if the magistrate can be briefed by the investigating officer behind your back? Would you have faith in the justice delivery system? Is a question to ask. By the same token, another way to ask the question would be happy to have a tribunal which is chaired by one retired magistrate and one retired Director General of Police, and say all criminal law matters will be handled by that tribunal. One technical member, one judicial member, and say all criminal law matters will be dealt with by such person. So these are deeper questions to ask. So when it comes to law on law making, we have to think through, have we as a republic modeled a system which makes law work? So when a law is made in parliament, if you follow the rules of law making in parliament, there are supposed to be 3 readings of the bill. And because parliament can't debate every bill, standing committees are formed, which is a subcommittee of parliament. So standing committees are meant to have public consultations in all parts of the country. They go state to state. If you look very closely, and those of you who look at public notices, you will find little boxes of ads saying, so-and-so standing committee is studying so-and-so bill is now coming to Goa and conducting a hearing. Now, how well is it publicized? Who goes and participates? These are all operational questions, but there is a procedure for law making. When it comes to a regulator making law, this pre-legislative consultation very often breaks down. So when a new law is made, for example, I have been on the insider trading law writing committee or the takeover regulation law writing committee, we would form a committee, we would engage with members of the public and draft a law and suggest that law to civil. But say 2 years later, on a material particular, that law is amended. There is no consultation, there is no public stakeholder consultation involved. So is that something that we are happy with as a republic? Is again a question to ask. I mean, if you, the regulator tends to behave very much like any law-making body which will not have an opposition to ask a question. And that can lead to laws being made which do not meet the actual problem that has to be solved. When I say show me a problem, I'll write you a law. Very often that pre-legislative consultation gives you an answer as to whether the solution fits the ailment. Otherwise the medicine can be more painful than the ailment. And there's again jurisprudence on this. You remember the call drop case, the telecom regulator felt that if you penalize the telecom service provider for every call drop, call drops will stop. So they published a consultative paper. The public consultations gave them very objective empirical input to say merely penalizing the telecom service provider will not lead to a call drop phenomenon stopping, because actually the problem is non-availability of spectrum. The regulator went ahead and made that law, which got challenged, got upheld in the Delhi High Court, went up to the Supreme Court. The Supreme Court said when you had objective criteria in your pre-legislative consultation to know that this ailment is thought to be cured by this medicine, and it will not really solve it. You still make the law. It's an arbitrary exercise of lawmaking power, and that law was struck down. Another parallel is the drug and cosmetics law, where the question of whether to tag veg, non-veg, green dot, red dot or maroon dot was introduced through the drugs and cosmetics law. Now that legislation has a inbuilt mechanism of a technical advisory committee which would review a proposition and say whether this is technically feasible. And the findings returned was it would be impossible to break down to the last ingredient of a drug or a cosmetic and certify that this never had any non-vegetarian source in it. And like Jehovah's Witnesses or certain communities do not take medicine. Like people, Jehovah's Witnesses would not take blood transfusion, for example. It's against their religion and they wouldn't want to take blood transfusion. So the other said, if I have to take a drug, I should know whether it is vegetarian or not. And the technical advisory committee said this is impossible to certify, so this standard can't be brought in. The standard was still brought in. It was upheld by one High Court, struck down by the Supreme Court, saying that it is so obvious that there is a pre-legislative technical review system in the legislation that was meant to be a check and balance on bringing in prohibiting bringing in unenforceable law. You still bring it in, therefore it's an arbitrary provision, and they struck it down. To complete the story, what transpired is the same law was brought in under the metrology law, which involves packaging. Now, metrology is about weights and measures. It is about quantitative measures and not qualitative measures. So our High Court has stayed that, and it's pending. So I won't comment further on the metrology law facet of the matter. The only point I'm making is when we speak about regulatory interventions in economic activity, demystified, simplified, it's all about common sense. It's about whether how to read a law, what was it meant to curb, what was the mischief in society that preceded that law. Try and meet the provision. If you are in doubt on how to interpret that provision, you have to look at the antecedent social conditions, see if you can discern the mischief sought to be suppressed, and an interpretation that would further the remedy and suppress the mischief is the interpretation that would apply. So that is a facet that across this financial sector is something that we need to think through. I think I should stop there. And thank you very much for having me. I leave something for interaction. And thank you, especially to Mr. Pereira. I just learned that when you were AG of this state, I was in my first year law. So with all humility, I have to thank you for having me here.
No, it's a pleasure.
Yes. Thank you.
Thank you, sir. We will now have the interactive session. I call upon Advocate Shailendra Bobbe, Public Prosecutor for State of Goa at High Court of Bombay, Goa, to conduct the interactive session.
Yeah. Any questions? Okay. Shivan.
Hello. Hello, sir. Yeah, how does pre-IPO shares regulate in India? Pre-IPO shares, unlisted shares.
Unlisted shares are regulated by company law. So even the company law, there's subordinate law now on private placement that has to be met. So it will be governed by company law.
First and foremost, let me say that your speech was absolutely insightful and riveting. The constitutional perspective I thought was quite intriguing. So the question is, with your vast experience, do you think the contours of price-sensitive information is clearly defined in the country and internationally? So that seems to be a subject matter of criminal and civil action across the world.
These are again one other element I should have perhaps touched upon. There are two types of approaches to lawmaking. One is a rule-based lawmaking, and the other is principles-based lawmaking. So what is price-sensitive information would necessarily have to fall in principle-based lawmaking. And the principle is that if this information were published, was it reasonably likely to have a material impact on price discovery? If that principle is understood in its simplest terms, it is not that difficult to comprehend. There will always be some element of grey. What percentage of price movement? Sometimes we even had cases where on actual publication the price doesn't get impacted. But price discovery is based on 10 other things. Suppose it was great news and on publication Trump announced tariff which affects that very company. The price would still tank despite that news being good news. But when you are in possession of that good news, if you traded, the inferences that you sought to profit from the benefit of that good news, that it didn't really have an impact doesn't matter. So from a principle-based perspective, if you look at it, you can't get better. You won't be able to say that a certain percentage of impact is material impact. You won't be able to say that a certain type of information will always be UPSI. That was the old law, by the way, under the 1992 regulations. In the 2015 regulations, we said that the following types of information would ordinarily be price sensitive. So take for example dividend. Declaration of dividend will be price sensitive. But say a company is declared dividend at 5% for the last 20 years and it yet again declares dividend at 5%. The market expects it to declare only 5% dividend. So just because it's dividend and the board was meeting about dividend at the same rate of 5%, that insider would not be in possession of price sensitive information. It would be in possession of unpublished information, but it is not price sensitive because there was nothing new. But say the company that year was making a departure and doing a 20% dividend. The same dividend news as a class would become price sensitive because it was going to make a material change from what its dividend policy was. So these are facets which you have to leave it, and that in some sense this is one reason why adjudicating regulatory matters like this can never be faceless. Like perhaps faceless is tried in tax because it will just interpret the letter of the law. But even there, as both the earlier speakers have said, elements of facts would be involved. But let's say you discern those facts and put it to accounting standards and your treatment in the books, you could still create a de minimis threshold above which it could go faceless. But in a facet like this, you have to be able to show what drove that internal process, what was the decision, could it be price sensitive or not. So it's a principle based work.
Is that how it's understood internationally?
Internationally, it's the same thing. So take Rajat Gupta's example, which all of you may be a little more conversant with because of the news it made. The US SEC wanted to go after Rajat Gupta through our version of Section 11B, the administrative action, to say that he should be prohibited from dealing in securities, etc. He said, you're choosing this standard because you're choosing a civil standard. You're deliberately ignoring a criminal standard, which is the standard you apply to Rajaratnam. And you ought to not skirt the issue by trying to get me with a low-hanging standard. And the rest is history. So, a criminal judge felt it was enough if two calls had been made in the course of a board meeting. It's enough to infer that he told the person on the other side what was to be discussed in the board meeting. So, circumstantial evidence is often mistaken and mixed up with beyond reasonable doubt. People are sent to the gallows also on circumstantial evidence. So circumstantial evidence is what the criminal court went by. And this was the debate many had. Many felt, oh, this is too loose a standard. You're sending a man to jail, a man of repute to jail. But this is a universal situation, nothing unique to India.
So, what do you think is a threat to fair trade practices, as you said, from the advent of technology and maybe AI or algorithmic trading, things like that? And how do an individual protect himself if he relies on technology to trade in shares?
It's a little more complicated, it's a wider area. Maybe you should have a workshop on technology and the impact on legal systems. But generally, if you again simplify this, the ability of technology to reach the human mind in ways deeper than hitherto envisaged is writ large. Eminently, people of greatest integrity, but who are insecure about losing the perception of their integrity, succumb to digital arrest calls. People who have nothing to hide, if they are told consistently once their attention is gathered that your reputation will be in smithereens, they are willing to get out of it by paying some money, despite having nothing to hide. So the technology's ability to enter the human mind is deeper. An innocuous link sent to your email, an innocuous link found on a website of surfing, an innocuous forward on a WhatsApp group, enables entry into your mind. That we have to retrain ourselves, we have to reorient how we are, what we buy, theories we buy, imaginary problems we buy into. This digital arrest is an imaginary problem, hate is an imaginary problem. So this is something that will impact even trading. If somebody tells you the stock is going to go up, it's going to have a great value.
Yeah,
so you may believe it and
just correct my question there. I was asking about if we rely on technology to trade, as you rightly said, there was an incident where a person was treated as following an unfair practices because he sold and bought options. Let us say this is suggested by technology. Let us say a program suggests me that.
So let's take algo trading. Suppose you program an algorithm to put in a trade in the example I gave at 100 and at 50 within seconds of each other and confuse the market. Frankly, in the example I gave, it won't fit because in the example I gave, people are putting in that trade only because they knew there's a counterpart. So if a program were to blindly throw up a purchase order at a price that's a huge premium to the market, the rest of the market will react to it and will end up buying from a real counterparty at an inflated price with no assurance of reversing it. So in the example I gave, technology won't fit, but you could program algorithms which would play in this space and it need not be such a wide range. An algorithm may say I'm a buyer at X and seller at X plus 0.5. Question really is that illegitimate or is it not illegitimate? Then you have to rely on the price bands. In the market regulation there are price bands. So some stocks, there are no price bands which are very liquid, and for stocks which are not very liquid, there are bands, plus or minus 5%, plus or minus 10%. So if you write a program that consistently says go to the end of the band, it could fall foul of an unfair trade practice. A tax practitioner may say, the law allows plus 5, minus 5. So long as my program says plus 5, minus 5, you can't find fault with me. A certain judge may agree with that view. A certain judge may not agree with that view, saying those are bands, those are guardrails, they are not licenses to swing the market plus minus 5%. Law will evolve over time. I hope that answers the question.
Rohit Palala. So in today's time, when technology has entrenched our lives so deeply, is there any scope for privacy and privacy protection laws, or are we too late?
There is a huge debate going on privacy protection, data protection law. The chairman of the committee who wrote that law has disowned the current form of the law that it's come out in. There's a huge debate. I mean, is it a protection law? Is it a licensing law? State having access? These are all in the realm of the legislature. It's for society to engage with legislature. It's for society which feels strongly about it to speak up, speak to your respective MLAs, influence the law, MPs, influence the law, So this is not something I should comment on in my current position.
Sir, if I may ask one question, is considering I would not, as your Lordship said, I wanted to ask about the current request by SEBI to the government asking for more interventionary powers to intercept messages, but I would not ask that question here. But the other question I wanted to ask was this: is are we, as the regulator, SEBI, is it asking for powers or the regulations which are created, the FUDP regulations, are they devoid of taking into consideration behavioral economics? And I will take the reference is, right, say 25 years ago, your Lordship appeared in the Samir Arora case, to today, Rajan's case, where if Rajan had literally followed the regulations, he would have actually made a profit and would not have been subject by SEBI to disciplinary action under the regulations. Are we over-regulating ourselves as a country?
So again, a tricky area. I'll keep it philosophical, not necessarily in the securities law space. But as a society, we Indians feel that whenever a wrong occurs, there is a lacuna in the law. And that is why this principle comes, show me a problem, I'll write you a law. We feel law, we can legislate virtue. So we are a over-regulated and under-enforced republic, generally speaking. I mean this totally generally, not with reference to any particular branch of law. Because state capacity is finite. Human ingenuity is infinite. So if you just write more laws, you are burdening state capacity to implement those laws. Like when a Nirbhaya happens, we amend criminal laws and we make it so much more draconian and stringent. And then Shakti Mills happens 2 years later, and then RG Car happens. So we have to ask ourselves, is just asking for more laws, more powers, more stringency in punishment going to achieve virtue? That's a question, that's a wider question we need to ask. And the regulators seeking more powers is a symptom of that. The regulators are always the neck is in the line. No regulator wants a collapse in its backyard. If there is a Pashamita scam or a stock market scam, you take the 91 or 2001, no regulator would like to say, my system failed. What they would say is, my system failed because. So give me more powers. There have been attempts to say that if a person makes profit beyond a certain threshold, we will deem it to be fraudulent. Onus is on him to prove the negative. Now this is like saying, if a student decides to buck up and does very well and gets great marks, we will presume he copied. So punish the student who has the highest marks, or suspect the student who had the highest marks because he is worked hard. Let him prove he is worked hard. That doesn't sit with our constitutional scheme at all. So this tension of asking for more powers and getting some powers, it's called it's universal. Globally the name for it is mission creep. Regulators creep up, and it's a creeping acquisition of more and more and more powers. That's the interplay that you see generally. So I thought I'll leave my answer philosophically, rather than comment about whether our regulators are right or wrong. I can only tell you that our securities regulator is one of the most empowered regulators in the world. Just as our courts are one of the most empowered courts in the world. A law made by Parliament can be struck down by our courts. Likewise, what our regulators can do are powers which other regulators don't have. You can be a prosecutor and the jury in the same case under our law, and that's so far constitutionally right. It's something that constitutional courts will see something.
Just to ask a follow-up to that, I know I'm straying into controversial territory in this aspect of the issue. Is the recent advertisement for the SEBI chairman, which has come out, And no, I will not go on to the merits of the advertisement, knowing this. But the minimum age is said to be 50 years. The youngest SEBI chairman so far has been the present one, 57 years. Are we confusing? I mean, when I say confusing age with competence and domain expertise.
Again, very important question. Forget SEBI. Again, falls in the realm of, is this a reasonable restriction? Is there anything to say that a person of a certain age gains wisdom and a person of a certain age loses his wisdom? The RBI governor has no age limit. If you look at the Reserve Bank of India, there is no age requirement at all. If you look at some of our tribunal laws, there are age limits. If you look at judges, there are age limits. When a judge is supposed to lose his wisdom at 62 or 65, depending on which bench he is sitting on. So these are things, this is an issue. So in the financial sector legislative reform commission, we had dealt with this issue. And we had said no minimum age. But we had suggested a maximum age. But the way we wanted to tackle it was 2 terms of 4 years each. You can't go beyond 2 terms of 4 years each because regulators need to change. You take Alan Greenspan, he was the Fed Reserve Chair, forget his age, he was the Fed Reserve Chair for decades. So when the crisis happened, people wondered, was it wise to have had one man as a chair? When the 2007 crisis happened, he was the chair across presidents. So the way this draft law recommended was 2 terms of, I don't remember, 4 or 5, and that's it. And of course, there's a very unpopular provision that for the second term, the incumbent would be as much a candidate as the other candidates for the term. Because a regulatory chair is a very powerful post. So one of the chairs, when it was suggested to him, not before our reform report, he was asked to be one of the many candidates, and his answer was, I'm neither an applicant nor a supplicant. So this is an area which is, again, legislative wisdom has to come up.
I have one question. I've been following this Hindenburg report case about short selling. Now, what I want to ask is, short selling, is it a cause for concern as far as the Indian market is concerned? Second question is, how far does the SEBI provide a mechanism, if it is a menace, to tackle with such a situation? Because what we see is that after publication of that report, Hindenburg has shut down and it has caused a great market ripple. So in this situation, what I want to ask is, as far as the Indian market is concerned, what are the causes of concern? And second, how does the SEBI have a mechanism to tackle such a situation?
By invoking the name you did, you almost made me decide not to answer this question. I mean, for obvious reasons. But let's leave the allusion to the name aside. Short selling as a concept came in for worldwide regulatory examination. And in 2007, when many regulators banned short selling, India was the only country which could proudly say we don't need to ban short selling. And I explain why. Short selling is selling a stock you don't own. And the price goes down, you buy it back and cover up your short sale position. But you can trade in an option. You can trade in a put option or a call option. You don't need to own the share. So ours was the only regulator which said our systems are so sophisticated that we don't need to look at short selling at all. So this is a complete red herring about short selling being detrimental to the market. Is it for or against? Today, as we speak, you can short a stock in the derivatives market. You agree to buy or sell a share at a certain price on a future date. If you say I'm a buyer or a seller at X price, you can short a stock. The same economic impact. So this is a complete red herring, and I think I'll not say more on this subject.
I know people are hungry, but the one last answer. I can't. Sorry. Can I just? Yeah, sure. So this is Advocate Gauri Shabli.
My question to you would be, now we hear a lot about crypto trade and crypto frauds. I understand that there is no direct law which is today perhaps regulating crypto transactions. So is there any law which regulates otherwise crypto trading? And sir, how do you see the regulation of this particular trade? And in the event, because crypto involves blockchains and complex transactions where you don't know at the end the point of it. So in case of a crypto fraud, what is the law regulating it, and whether the prosecution is limited to regular penal laws and remedies to it?
The complexity of crypto is immense. Crypto is a creature of contract today. Whether to ban crypto, regulate crypto is a question at large. And I don't see much difference in that question. Of course, there is in impact, but philosophically there is no difference from considering whether Uber is a taxi or not. I don't know if the Uber really works in Goa or the local system has ensured they can't be Uber by ground policing. But if you come to Bombay and you ask yourself, is Uber a taxi or not? Or again, a more controversial question for this audience. Is a chartered accountant a lawyer or not? When it comes to the tribunal, he can appear, he can address court, he can deal with it. He does everything that a lawyer can do in that tribunal. So is he a lawyer or not? So as technology evolves, as systems evolve, market products evolve, this is what regulators call the dilemma of what often they put it in a sandbox, which is basically let it grow. Then let us see whether there is a need to intervene or not. Sometimes it can have serious consequences. What is the alternative? The alternative is to say, if I don't understand something, if it's too complex, I will ban it. Anything that you ban goes underground. Prohibitions don't work because then the activity goes underground. And we've seen how prohibition works in states which have prohibition on liquor. So it would be a similar dilemma. So therefore, with crypto today, one will have to see if the rights and obligations of the parties are governed by contract, it would be determined by contract. If it's governed by contract in the form of bylaws which are in some sense a contract between the members of the platform and the platform, it will be governed by the provisions of contract contained in that bylaws. There is a larger question about is crypto a security? There was a larger question many years ago, is a plantation scheme a security? And very often when you see the history of regulation making, regulators will initially say, this is not a product regulated by me, because I don't want to be responsible for it. So if plantation schemes were booming, every regulator said, this is not my product, this is not a product that fits my market. It's not a unit of a mutual fund, therefore not mine. It is not a deposit in a bank, the RBI will say it's not mine. It's not an NBFC, not mine. And this is how the product develops. And sometimes it could lead to a serious economic cost and a crisis. But from crisis emerge newer ideas and newer structures. Crypto is currently in that space. Question again is, illegal income can also be taxed. Income is income. So would you subject your crypto earnings to tax? I think that the two colleagues who have spoken before me have to answer. But these are areas which, the day it blows up, the enforcement machinery will be very heavy-handed, is what you can expect. Because depending on the gravity and scale of the blow-up, will be measured the political answer to the blow-up. And therefore you expect the gravity of the response to be commensurate with the gravity of the problem when that blast happens.
I think we come to the end of this because I'm told that we are
Thank you. After hearing the three sessions, we know that the avoidance of tax is the only intellectual pursuit that carries any award. Now moving on to presenting of the mementos to our esteemed speakers, I would request the President of the Goa High Court Bar Association, Senior Advocate Shri Koil Prera sir, to present the token to Honorable Shri Justice Mahesh Sona, Judge High Court of Bombay. Thank you, sir. I request Advocate Rama Rivankar, Secretary, Goa High Court Bar Association, to present the memento, Treasurer, to present the memento to the Honorable Justice Jitendra Jain, High Court of Bombay. I request Advocate Shivan Desai, Secretary, Goa High Court Bar Association, to present the memento to the Honorable Sri Justice Somsekar Sundarasan, Judge, High Court of Bombay. I request Advocate Maria Simon Correa to present the token to the member of the Goa High Court Bar Association, to present the token to the Honorable Miss Justice Judge Nivedita Mehta, High Court of Bombay, Goa. I request Advocate Prashila Arulkar to present the token to the President CA, Mr. Milind Shirokar. I request Advocate Dattaprasad Lavande to present the token to the Honorable Justice M.S. Sanklecha, Retired Judge, High Court of Bombay. Thank you. Gratitude is the sign of noble souls. I request Advocate Shivan Desai to propose the vote of thanks.
Good afternoon, everyone. It can be quite challenging to deliver a vote of thanks because normally it stands between bringing down curtains on a function and a lunch, and people who are otherwise in rapt attention, they start wiggling on their chairs. But it is an important task all the same. On behalf of the Goa High Court Bar Association, I extend heartfelt gratitude to all those who are present here, the esteemed judges, the distinguished chartered accountants, the participants for today's function. Everyone has given this function the necessary flavor to make it insightful and thought-provoking. To start off, the honorable judges of the Bombay High Court, the keynote speakers, they gave us clarity on tax laws. Tax and clarity seem like an oxymoron, but to the extent they could, they gave us clarity, and each one of them brought different perspectives. Justice Somashekar delivered a fantastic speech on market laws to which most of us are not very exposed to. And last but not the least, all the participants who have made this into an intellectually stimulating exercise with your questions and participation. Thank you one and all, and we'll see you for lunch very soon.